A very good afternoon, everybody. On behalf of IMC Chamber of Commerce and Industry, it gives me, Manasi, great pleasure in extending a hearty welcome to all of you, especially our distinguished speakers, esteemed panelists, and all you participants and delegates to the second day of this two-day 11th Banking and Finance Conference, which of course is happening virtually due to the current health crisis and concerns. Ladies and gentlemen, the theme of this conference is how technology is reshaping banking and finance. This two-day conference has HDFC Life as platinum sponsor. Gold sponsors are BNP Venture Capital Limited and Standard Chartered Bank. Reach Media Global is the webcast partner. With those words, I request Mr. Dushyant Dave, Co-Chairman, IMC Banking and Finance Committee and Chair and Founding Director, Decode Resolvency International Private Limited, for the welcome address, as also to give a summary of day one and deliberations and brief on sessions of the day two as well. Over to you, Mr. Dave.
Hello. Thank you. Mansi. Good afternoon, ladies and gentlemen, and all the distinguished speakers of today's event. I am honored to give you the summary of the day one event of the IMC Chambers Banking and Finance Conference. I'm the managing committee member of the IMC Chambers and co-chair of the Banking and Finance Subcommittee under the chairmanship of Mr. Arijit Basu, the former MD of SBI. I thank Mr. Basu to give me the opportunity to share my inputs on the various sessions of the day one. I will now proceed to summarize first the inaugural session and then the three sessions which took place on the day one of this magnificent conference. At the outset, this is the 11th conference on banking, and I've had the privilege of attending all the earlier ones, which of course were always physical, in the large regal room of Oberoi or the Taj and attended by the then sitting finance ministers, sitting RBI governors, sitting finance secretaries, and almost all the sitting MDs of all the banks, be it private sector or public. While the theme of the present conference is on digital banking, it just happened by coincidence that this meeting is also happening digitally and with all its pros and cons of the digital banking. The conference began with a video tour of the IMC Chambers, its history, its activities, its partners, its leaders, and the glimpse of the illuminaries who attended the IMC events. To speak on the history, what a history IMC has. It's humble to mention that Mahatma Gandhi was IMC member when the Chamber started its journey over 110 years back. Since then, IMC is witness to a number of events unfolding in the country and the state of Maharashtra and is an ardent supporter of the business and industry across the sectors. This video tour included the glimpse of our present Honorable Prime Minister Shri Narendra Modi as well, addressing the IMC event in Mumbai. The video tour was followed by the inaugural speeches of President Shri Rajiv Podar and the Banking Committee Chairman Shri Arijit Basu. President Rajiv Podar rightly mentioned that every event of IMC Banking Conference is a better event than its earlier one. He looked at a rear view mirror to banking industry and how new development like AI, chatbot, etc. are at front now in the new digital banking. He talked on how Fintech industry is growing at a CAGR of 27%. Artificial intelligence, machine learning, blockchain are new words in the system as against check clearance or check deposit or cash withdrawal, resulting in a boom in the financial industry. He emphasized, though, that the need of the hour is financial inclusion, bridging gap between the urban and the real. And this is what a lot of other sessions speakers have also emphasized upon. He rightly quoted Albert Einstein, who said that in midst of crisis, there is an opportunity, and it aptly gives the direction to proceed in this, hopefully, post-COVID times. He briefed on IMC Chambers and its activities and how is it engaged in nation building and voice of our 4 lakh beneficiaries, including individuals and the trade bodies. Shri Arijit Basu set the tone for the theme. He spearheads our banking committee, and he had spearheaded State Bank of India, the largest financial institution in the country. He thanked all the speakers in spite of their busy schedules, and it's a fantastic line of speakers, as I will narrate shortly, which was happened yesterday. He justified the need, the theme of financial technology, because if you have to reach to the mass, you can reach only through the technology, and that's how the financial technology in the banking and finance becomes very paramount. He has also talked about Mr. Kamath, who is shortly addressing our session, and how he's presently heading a committee for the stress asset guidelines as appointed by Reserve Bank of India. He then did today, he detailed what are the speakers and the subjects, and that's how the next session started. The first session was on the corporate governance, moderated by our own committee member, Mr. M.K. Chauhan. We had two eminent speakers, Ms. Nainal Kidwai, ex-HSBC head, and Mr. Richard Kulus, ABN AMRO head. Mr. Chauhan started with narrating the latest amendments in India, which is very interesting, which says that all the board committees in the companies will have to have, necessarily to have all non-executive directors and independent directors as a chairman of all the committees. He compared this with the global practices. Then Richard talked about the journey of ABN AMRO, how it started from 2010 under a forced situation. And now they have encompassed almost all the necessary ESG guidelines in their policy. It has become a ESG policy, it said. And then, of course, Ms. Naina talked about the challenges for corporate governance in India. She says that it's important for bank to be aware of the effects of lending to whom, why, and for what. She said, while Indian banks boards are of course world class, they must move to bigger size setups and the public sector unit banks as well. See post query that how many boards discuss ESG. ESG, of course, is we all know it's now the latest. It's not a fad anymore. It's a practice being practiced by the companies as well as the banks across the world. And if this is a high time, and large global investors demand ESG compliance, as a matter of fact, World Economic Forum too has emphasized this. Now the COVID has made S part of ESG on the forefront. Richard then informed about the recent amendments in Europe in ESG regulation. Sustainability is becoming core of a banking industry. Factors like climate risks, etc., priority now. Price of money will go up if you are not ESG compliant. Your cost of capital will go up. Along with financial results, there is going to be now ESG report. So it must be standardized and tabulated, the panel discussed. Panel also discussed that the taxonomy is a must for the ESG, and sustainability standard board globally required to be set up. And Naina then spoke about how banks will act on the ESG, and while all European banks are complying, India should create its own model and norms under which banks won't lend to companies which are in negative industry or practices. A stress test or a scenario testing planning will have to be done. Whether this can be done or not is no more a question. How it is to be done is going to be the deciding factor in the times to come. In India, ESG lies under CSR policy across, and that's basically wrong. This needs to change. It has to be a separate practice itself. I think for me, it was like a master class on ESG. And I thank Mr. Chauhan to lead such a fine session with a very fine speaker. This is like a rewiring for a digital and green economy. And this set a stage for the next session. The former Deputy Governor, Ms. Usha Thorat, and Mr. Padmanabhan, also former Deputy Governor of RBI, were interviewed by CNBC fame Lata Venkatesh. And it all started with the Bank of England, which has set an agenda that green must be embedded in all the central banks. So the first session was carried forward by these two fine speakers on how the green can be embedded into the banking system as well. It was said that all the regulator must take a lead, and this will be required for financial stability. Task forces are created by RBI and SEBI, and that's what Mr. Padmanabhan informed, that India is not far behind. RBI is putting the plan in place. SEBI is putting the plan in place. ESG private equity funds are getting set up. And Ms. Usha Thorat rightly said that when 70% in rural India is in rural India, you must think about land, water, rivers, environment protection, and so on. And the implementation of this has challenges and requires a strong political will as well. So it needs a political sensitization, as the panel said. On digital economy, there was a concern why banks have not been pulled up for not adopting digitization. Interesting comments by Mr. Padmanabhan, though, that are the people ready for digitization? And if 80% are not ready, then this can't be implemented. Sizing of infrastructure is an issue. So planning is an issue. Continuity of the planning is an issue. And customer education. So that's a bigger issue than giving physical digitization as well. This was a very interesting side point talked by the panel. This was one of the most enriching talk on the greening and technology, 40 minutes talk by these ground experts, I would say, who did that. This was immediately followed by, the conference has been so brilliantly structured that it starts from the basics and then takes you straight away now the next session followed with investing into the BFSI, that is banking, financial services and insurance industry, its opportunities and risks. Our own committee member, Mr. Anantaranaran, he interviewed a very fine panel. It started with Deputy RBI Governor, Mr. Vishwanathan. He talked about regulatory sandbox, a very fine word which I have noted myself. That it's the support of regulatory in digitization is changing the landscape. Beginning was done with the banking correspondence, and now it's leading to small payments bank. Mr. Vishwanathan said that he claimed rather that information asymmetry is gone. Is RBI is sharing all the data. This can be basis to consider investment in this sector. EY Finance Services head Mr. Abhizar Divanji. He started saying that India has best payment systems, one of the best payment system in the world. He talked about future of banking, and he went ahead to define ABCD of banking. As a matter of fact, in this conference, I've learned a lot of new alphabets. The ABCD of banking has been defined as A for access to the mass, access to the people. B for business enablement. So the technology should enable your business. Banking should enable your business, not destroy your business. C for customer, it should be customer-centric banking. And D for data, it should be data-driven banking. This is a new ABCD of bank, and banking will remain, but banks may not. A startup may in future end up acquiring a public sector bank, a farm easy movement in the banking, as I said. Or data can make anyone bank worthy if he is not, even if he is not. How? So you can make a consumer credit worthy by observing his consumption, and if there is no, even if there is no balance sheet. And the panel also supported the corporates buying the bank. It's a good news for all the corporates who are hearing this. Mr. Narendra of Warburg Pincus talked about private equity perspective in the BFSI sector. He said if there is a confusion to allow private sector to acquire bank, people are debating whether private sector should be holding bank or not. Then private equity fund holding a bank is a good hybrid middle solution. Mr. Patnaik, who represented the large NRI investor community and talked about challenges faced by NRI in investment in India, he gave his suggestions on facilitating the NRI investment. As example, he suggested that IFC Center, which is in Gandhinagar, should be opened in many more cities. Mr. Ishan Mittal of Sequoia Capital talked about their investment interest in those businesses which is growing and changing, and Fintech is one of those businesses which is growing as well as changing. And so all the PE funds definitely want to look forward to investment into the BFSI space. Collaboration is happening between Fintech and large banks. India stat and video KYC is probably only in India where you can do a video KYC, and it is giving wings to the financial technology. Warburg said enough opportunities are in place. He talked about what quality entrepreneurs must have to attract the capital. He asked why PE are not allowed to invest, and he suggested that PE should be given more opportunities. The technology, now the next session was actually a very interesting session by none other than the co-chair of our finance committee, Ms. Zareen Daruwala. She could bring on table in our conference the global head of her bank in this conference, and we had a very interesting discussion. Ms. Zareen Daruwala and Mr. Bill Winters, they talked about how tech is shaping Stanchart, digitizing everything they do. Retail business and 26 markets of Stanchart are working on digitization, in corporate banking too. Discussion on whether big tech company getting into financial services is a challenge to banks Standard Chartered has allowed financial services on a third-party e-commerce platform. As a matter of fact, Standard Chartered made a comment that it is we banks who are spearheading the fintech and e-commerce into the banking. Investing in new technology for reducing carbon footprints are presently very expensive, so he suggested the part of money should be put in research to get how can the present technology be scaled up at lower prices to spread it across. Bill Gates Foundation has agreed on this and earmarked a big sum for this research. He also said that Amazon presently, a very big remark, that Amazon presently emits out much more carbon than it actually reduces. To what extent digital bank can disrupt traditional banking sector? He replied that every part of the world has digital banking and most of that has come from traditional banking. Standard, in fact, has been disrupting themselves by offering digital banking to young millennials. So lots of opportunity in India as per Standard Chartered. That was actually picked up immediately by the last session, which talked about the redefining the fintech space. Fintech space, this was perhaps the most interesting session, and all these first 2-3 sessions led to this last session, talking about the actual practitioners who have set up the e-commerce and the very large fintech businesses as a proof that the fintech works. We had Akash of Cash Free Cool Tech, which is we had Rishi Gupta on a Fino Payment Bank, which is 15 years old bank now, turning from a physical to a completely the new word which is again coming is a physical and the digital. So he talked about a physical space. Manoj Sharma talked about the microsafe startup. He narrated how 11 licenses given to payment banks have trimmed down to only 4 and 3, and how now all 3 of them are profitable. And out of that, 2 are becoming the small finance bank itself. Capital backing is happening big time in this space, and it's a must for any financial services industry, as we know. He said how payment is for starting point of a fintech product, and how insurance is now becoming a big play as well. COVID has made people realize insurance and savings. Gold loans is 3 times post-COVID, thus monetizing gold savings. Thus, very interesting markets are growing up in fintech space. He also informed 94% of population get food grains, and there is 820 million people covered under a food subsidy, largest in the world. Credit startups are definitely going to do well in this. And in second round, 90% people actually paid their loans in microfinance customers. That's a great news. And they all summarized their own business successes in this. In conclusion, to make it a 5 trillion commodity finance fintech industry is a necessity. Next 15 years will be a massive acceleration, as the panel said. And as our president mentioned in his opening remark, every banking conference is better than the earlier one. Same holds true for the current conference as well. The second day of this conference is now power-packed with such a rich agenda with the most knowledgeable captains of the banking and finance world that I'm excited to give you a brief glimpse of what is in store for you right now. We start with the fireside chart with Mr. KV Kamath, who is already present right now. Like in saying by Mr. Vinayak Chatterjee to deliberate on harnessing the infrastructure pipeline and what are its imperatives. Mr. KV Kamath has recently served the equivalent of the World Bank in this part of the globe, and we will learn a lot from his wisdom on these sectors. This is followed by a session on a building and scaling world-class platforms, and we have co-founder and heads of companies like BillDesk, Open, a neo-banking platform company, Udan Capital, Epic head of WISE, which was formerly TransferWise. The session will be conducted by our own finance committee member, Ms. Mrudula Iyer, who heads Treasury for City South Asia. This session will lead you to the knowledge that the financial world is rapidly changing to the world of platforms, tech platforms, just like any other sectors. And these brilliant promoters who have built up these successful platforms will share their journey experience with you. The final and concluding session is aptly the climax of all the sessions of these last 2 days. When we discussed all the topics of the fintech and digital banking and ESG during the last 2 days, who takes the final call? The big bosses of the big banks. Mr. Arijit Basu, of our committee chairman, has put together a brilliant panel to speak on the future of technology in banking and financial services. SBI chairman, Mr. Dinesh Khara, Ms. Arundhati Bhattacharya, ex-chairperson of SBI, but herself now a CEO of a large tech company, Salesforce. Ms. Viva Padalkar, MD and CEO of HDFC Life, and Mr. Prashant Kumar, MD CEO of Yes Bank. A fine combination of the private sector and public sector banks, honchos, along with the IMC tech company and a life insurance company. What more would you want? This could be possibly only thanks to the personal efforts of Mr. Arijit Basu. So here we go, ladies and gentlemen. Don't miss any session. And yes, if you have missed day one, do visit IMC website for the video link. You'll have a complete program being available to you. We sincerely hope that our next conference will be phygital, as that's the coin going around in the fintech space. Over to Mansi, who has been doing a fantastic job as an anchor since yesterday. Thank you.
Thank you, Mr. Dave, for giving us an overview of yesterday's deliberations and, of course, taking us through today's agenda as well. Thank you again. Ladies and gentlemen, I take this opportunity to make a couple of announcements. Firstly, questions and answers are to be directed through the Ask the Question section on the screen bottom left-hand corner. Agenda and profiles of speakers are on the bottom right-hand corner. Due to paucity of time, we will not be able to read through the profiles of speakers, but then you can go through. Most significantly, the feedback form is in the bottom center of the screen. For us, it is very, very important that we receive your feedback for improving our future conferences and seminars. Do make it a point to fill it up. Well, regarding the questions and answers, you are requested to submit your questions in the Ask the Section question on the bottom left-hand corner of the screen. I repeat, please specify the name of the speaker to whom your question is addressed to. It will become easier for us to sort it out. And do not forget to click the submit button after the question is typed in the Ask the Question section. So well, with that, I will now begin the first session, which is on harnessing the infrastructure sector pipeline. What are the imperatives? This is a fireside chat with Mr. K.V. Kamath, moderated by Mr. Vinayak Chatterjee, Non-Executive Chairman, Feedback Infra Private Limited. Over to Mr. Chatterjee. Sir, I think, have you unmuted yourself, sir?
Now, can you hear me now?
Very well, very well.
Okay, wonderful, wonderful. Good afternoon, Mr. Kamath, and good afternoon to all fellow participants. I think I am looking forward to the session with Mr. Kamath on the big topic of infrastructure, the economy, and the spend. So, Mr. Kamath, purely as a kind of a stage setting and warm up, why don't you've always been known as the man with the big picture, the big vision, and you're not looking at today and tomorrow, but you're looking far ahead into the next few decades. So what is your vision of the Indian economy requiring, needing, and powering ahead for the next 25 years? What are the opportunities? How will infrastructure really drive growth and itself be a vehicle for growth? Who will execute and how will we fund? So why don't we start with the big picture first, and we will then drill down. Over to you, Mr. Kamath.
Thank you, Vinayak. Let me start by complimenting IMC on this initiative which they have been taking yearly. It's a great program. Look at the Indian economy. I think we need to look at a 25-year look forward scenario. In a way, the Honorable Prime Minister has set the agenda on this, saying that there's a runway of growth for 25 years. And upfront, I think looking at what has happened elsewhere in Asia, particularly, indeed, we have at least a 25-year runway of growth. Now, what are the components of this runway of growth? There are several. Key, fundamentally, is infrastructure. But there are two or three other momentum providers that will propel us forward. A is indeed manufacturing, which we can today say has come of age. I'll just use one metric to put this in context. 20 years back, we used to say, how will Indian industry fund itself? Because it was used to borrowing from banks, with hardly 20% coming from internal accruals or equity that the sponsors raised. 10 years we said, oh, it still requires 50% funding from banks. But today in the manufacturing sector, if you look at the cash flows, every company is cash flow positive after its investments and is able to deleverage. B, it is able to set up capacity just in time, saving cost. Of course, they are competitive today in a global context, and their quality is up to mark. So a far difference from 20 years back. This is what manufacturing has achieved. So I believe manufacturing will grow on its own in sync with economic growth. Then comes infrastructure. And then comes what I would call the new economy players, the digital startup. Since we're going to talk of infrastructure, I'll keep it to the end. I would think the other plank, which so far people have not talked about, but from what I could hear, is a key plank in today's banking seminar that we are having, is the whole digital ecosystem. In the sense, to me, this is going to be the momentum provider for a long, long period of time. We are at this point in time, a very nascent stage in this whole cycle, the digital super cycle, as I like to call it. All the companies that were mentioned in the preamble, the financial tech space, plus a myriad others who are in a variety of businesses, will all be providing momentum to our economy. Now, three things will happen in this path, Vinayak. One, these companies do not require debt. These companies are funded by equity. So we have our manufacturing sector not requiring equity, we have not requiring debt. We have the digital super cycle companies not requiring debt, will have equity either from free sources or other sources and drive momentum. And we are in this nascent stage, just 3-4 years, we now have seen the power of employment creation in the digital super cycle. I think yesterday listening to someone on television in a panel, we said that last year the startups, digital startups, created 1.7 lakh jobs. We used to say 20 years back, when the momentum was provided by the IT companies, that for every IT sector job that was created, 4 other jobs were created. Somebody you employ at home, you employ a driver, and so on and so forth. I think the same thing is happening with the digital super cycle job creation. They will have a multiplier effect on jobs. Whether it will be 1, 2, 3, or 4, time will tell. But clearly, they will accelerate employment generation in this country. So I would think a key plank of growth going forward is going to be the digital super cycle, financial and otherwise. That is fintech and otherwise. Then we come to infrastructure. Infrastructure, if you look at, I would take the best example is Asia. From Japan, the way it transformed itself from the 60s onwards. Then came the tiger economies, then came Southeast Asia, and the recent past is the track. And if you look at growth patterns, once infrastructure growth starts, it's a 25-year horizon. You first start building essential things. And those essential things we have started building. And I think we have the capacity to build them. And in our case, if you go back again, when you started your career and were right into the thick of it, the golden quadrilateral, the Pradhan Mantri Gram Sadak Yojana, then the telecom investments, early stage power reforms, and then power. And then going on to 2010, we had the new coal-based power sector coming in. And of course, that is now probably out of fashion. We now have green. Everything that we are doing green. I would think that our road building that is done to date is only the tip of the iceberg to meet the aspirations of a country of 1.3 or 1.4 billion people. So whether it is ports, airports, roads, whether it is telecom, whether it is green energy, et al., I think we are yet to be built. Of course, I should not forget, there is a whole mass of work to be done in what I term in a phrase, urban rejuvenation. That is transformation of spaces, whether it is a town or whether it is a large city, even a village, I think has to transform itself. I think this is probably the most exciting part of this journey, because while manufacturing is in, I would say, self-drive mode, digital super startups, some degree of handholding will be in self-drive mode. Infrastructure, I think, needs attending to, careful attention, and putting it on the growth path. So, in a nutshell, a 25-year growth horizon. I think if I look at the past, all those countries that we talked about during the rapid phase of growth, they all grew at upwards of 10%. And I think we have the equation right for that. There were two other preconditions that happened in those countries. That is, they kept, I would say, the interest rate under check. I think that is happening today. And they kept liquidity, I think, fairly easy. I think it is happening in our country even as we speak. And this should augur well for this growth momentum. I'll stop here.
Thank you. Thank you. That was indeed an excellent way of, dovetailing the past and the future. What was interesting for me is your reference to the early days of manufacturing and how we used to crib about lack of depth of, financing to start manufacturing, and how that's a thing of the past, and how infrastructure is very much the present, in as much as the new tech companies are the future. Very interesting, sir. But I now actually want to drag you straight into the present. Now, right now, we are sitting in the middle of an economic situation where most people are arguing that monetary and credit intervention has done whatever it had to do, and it is now about reviving demand by public expenditure. And nobody quite denies it, but nobody is also able to put their finger on how much. Recently, people have advocated anything from over and above the budgetary provisions. People have advocated anything from 1% of GDP, which is roughly 2 lakh crores, to maybe as high as 3% or 4% of GDP, which is as high as 6 and 8 lakh crores, as front-loaded expenditure on public works, on infrastructure, which should be spent immediately, not just to revive demand in an economic sense, but to take care of the devastation in jobs, in particularly across Bharat, and provide a stimulus to the demand for all kinds of secondary items like steel, cement, and various other issues. So we are talking about front-ending public expenditure with economists, shall I say, on two sides. A few of them who say, no, our debt is already high and we should respect the fiscal deficit and not allow it to increase. The others say this is not the time to be too strict about fiscal deficit, but let's front-end public expenditure, and we can go as high as 3% of GDP, if not higher. So I want to ask you for your views, sir. I mean, what would be your advice to the country, to the government, to industry on this whole aspect?
I think you have already paraphrased what is the problem, as it were, and the elements of the problem. I will address two key elements here. First element was, should you be front-loading? The second element was, should you, stretch the fiscal to do this? The first question answer is a clear yes. I think the government is clearly aligned to do that, and whatever the government has said very clearly, explicitly, points to that direction. I would think that a lot of self-sustaining has been done through the efforts that the government has been putting in a variety of ways, whether it is the food subsidy scheme or the food grant scheme, and whether it was the package for MSMEs. They needed the package, and now extending their helping hand to for microfinance borrowing. The moratorium that they provided in the first case to companies. I think they have done what could be done, and at this point in time, unless we see a very adverse set of results, the first quarter results, I don't think much is required. So what is now left is to make sure that you continue driving the momentum. And I think very interestingly, Vinayak, we are in a good position. India is in a good position. because you anyway have to invest. Because if your growth horizon is 25 years, you have to invest. So what we are probably doing is front-ending it a little bit. In that then comes the question, do we have the funding to do it? We'll come to that in a moment. But clearly, in the need of the hour is front-ending. And there is a variety of opportunity that is required to do. Now, how do you fund this? Again, same question as corporates used to ask or used to pose 20 years back. But to grow, we need debt funding, and we can't grow on our own. In course of time, that question became diluted. As I said today, that is not a non-question because they are cash flows. I think in the infrastructure sector, again, you know it better than almost anybody else in the country. If properly managed, we come very quickly. We could come to the same situation. Let's pick one area. Let's pick roads. And what has happened in road? You have lived this journey. 20 years back, if you funded a road project, whether you were a development bank or whether you were a bank, your execution risk was the biggest risk, from acquisition to all sorts of challenges and so on. That was the biggest risk. Now, let us say you went through that risk. Then you had the risk in terms of toll collection. Even though traffic started building up, some problem or the other, some challenge or the other, toll collection was. Today, if you look at it, both these risks, I think, are to a great extent mitigated. And with FASTag, the second risk, collection, I think is mitigated to a great extent. One risk then left, which is traffic. I don't think that traffic, even in the last 20 years, was really a problem. Going forward, if you have a 25-year runway, traffic is not going to have a problem. So you could now have innovative structures which very quickly could implement this project. And thereafter, this is, the loan is offloaded. What we used to term takeout finance, but I'm sure there are more interesting terminologies today to do it. Question is, who funds this, upfront, front loading that, we discussed? I know is two ways this could be done. One is, of course, the lending institution that the Honorable Finance Minister talked about, and she scoped it to a very large institution. That institution could provide the momentum for the first 2 or 3 years, by which time you then need the offloading structures, because if, as I said, I took the example of one industry, which are one sector, which was roads. If that example is right, then it is possible to very quickly monetize this asset and put it one structure. The second structure is, again, what several countries in Southeast Asia and China use this all along, which is fund these through special purpose vehicles of the government, to start with 100% owned by the government. So, and borrow from the market. So you don't borrow on the government's books, but you borrow in the books of the vehicle with an implicit or a not necessarily implicit guarantee, which you should give confidence to the person funding that this project will go through. Having said that, given the track record of some of our government agencies, particularly in the road sector, to self-implement, I think we should be doing well. We have come through a whole lot of teething over the last 10, 15 years, but I think we have come of age. I used only one example, but in other cases, similar approaches could be done at state level, at city level, at town level to do this. Blended with, let us say, multilateral funding if needed. And then, again, other structures in terms of, once you see success in a particular manner, I find in India, there's a whole lot of players come to the fore very quickly. And I'm sure that will happen. So, in that event, if this were done, we may not have to really answer that question. Should it be 1%, 2%, or 3%? But I will try to answer that question. I think this is a time to be brave. And I think the government was brave in casting the budget for this year. And, they said that they are willing to stretch the deficit to make sure that, we continue on our growth path. So that's the only way out of the challenge that we have. So to the extent that you need to stretch the budget, then you stretch, then you do it. But I don't think that is going to be a very large number. if we adopt some innovative structures in terms of funding. And I'm sure, given the momentum that is building up, this should be possible to do it, not only in roads, but in all the sectors we're talking about. Again, if for a moment we can talk about the airport side. Airports, government is very quickly onto it. The best probably structure is privatizing and going along with it. You then can talk about ports, you can talk about other areas. I think you're getting into others. Very interestingly, Vinayak, what would have taken a very large investment, green power, is happening without anybody talking about it. It's almost like our entire future power needs are coming in at half the cost of setting up and half the cost per unit of power, with nobody really making any noise about this. I think we are in a sweet spot in a very interesting way, which you have also observed. Being slightly latecomers to the table, we have had the advantage of looking at technologies maturing in somebody else's backyard, and they paying the high cost of getting the technology to mature, and we are getting the technology at probably the lowest possible cost. It has happened in telecom, it has happened in data, it is now happening in green power. So I think we are in a way in a sweet spot, well timed to execute these projects.
Thank you, Mr. Kamath. Very, very interesting perspectives. I liked your reference to SPVs, because for a long time, people like us in the infra space have been advocating standalone special purpose vehicles for government to raise finances on the SPVs and not on its books. You know, the first person who actually did this, you will remember, was Mr. Shahi when he was power secretary. The first 4 ultra mega power projects, UMPPs, were created as SPVs, exactly what you are suggesting. Not only does it help to raise finance outside the books of the government, but in the early stages of the SPVs, it helps with a huge amount of land acquisition and relevant permissions, which the government can get easily as a 100% owned government entity, and then it can sell the entity. It can then, offer the entity for sale. So your SPV idea is very, very powerful. And what is very relevant to some headlines today, if you see today's business press, I was reading in the morning that asset monetization pipeline is gathering momentum. And apparently the list prepared by NITI shows that about 2.5 to 3 lakh crores, so let's say 1.5% of GDP, is available through the route of selling government assets in a situation where the government need not have to own ports and power stations and railway stations and others. So the asset monetization route also provides an innovative way of actually recycling government expenditure that was front-loaded a few years ago. So that cycle can become larger as the days go by. Now, I want to ask you, once you talked about innovative institutions that the finance minister announced, and I am now going to lead you on to that. This budget announced the DFI, a developmental financial institution, which actually saw a very rapid clip from acceptance, budget speech, clearance in parliament, presidential assent notification. I hope it should be under implementation soon. You have yourself been at the helm of an institution that transformed itself from a very powerful DFI to a commercial operation, ICICI. Now, the jury is out on a DFI. Once again in India, I am of course very happy that the DFI has been created and executed and announced, because I really think the country needs it. It allows the country to access developmental finances. It allows the country to make long-term investments in public works programs. I mean, we tend to forget that in the Nehruvian times, things like the Bhakra Nangal, Hirakud Dam, steel authorities, etc., they were all made as long-term investments in the nation. So the argument goes like this, that the DFI should be able to make investments in large nation-building public works that provide economic returns as distinct from private capital that will look for financial returns. And the two are not necessarily comparable, because economic returns is based on large multiplier effects, like, let's say, like a Damodar Valley Corporation, from hydropower to irrigation to flood control. It is not possible for you to get a financial return, but nobody would argue that it has huge economic return. So the purpose of a DFI is to make investments in large public works programs and do the same kind of stuff that we discussed earlier, which is raise demand, raise employment, create the growth momentum, and leave private capital to take decisions based on financial return. So your comments, sir, and your perspective on the DFI and this whole discussion between economic returns and financial returns.
Yeah, I think you led to a very interesting discussion in terms of what next in terms of funding institution. First, let me address the point that you made that there could be people questioning why a DFI at this stage. And if the past we in a way abandoned that path and went to banking, I think it's necessary to put in context why that happened. It happened because the funding sources were very limited for DFIs in those days. It was government guaranteed paper which we issued and which was eligible as a SLR for banks. So they subscribed. The moment the government guarantee was withdrawn, you did not have a funding medium. You tried to access money from the market, it was too costly. And of course, the whole model then was not viable. So that was it then. Today, why is it feasible? Several reasons. Today, there is a very robust marketplace. And there is also the ability to create very robust financial instruments, which did not exist in the 90s. So given these two, you have the ability to formulate an institution, which the government has indeed done, which could provide the momentum that is required in this context. You asked a question, which is, should this institution be doing what we can call social lending, and should the private sector be doing, the projects where there is a return? Vinayak, I think it has to be a blend of both. The reason I'm saying, let me first address, in certain sectors, in certain infrastructure sectors, I think it is still going to be difficult for private sector to, under whatever structure, to move ahead. For that key point that you made a little bit earlier, that is the inherent risk in terms of, let us say, land acquisition or whatever, which I would all club as the execution risk. Those risks are probably reduced, but are still there. So I would rather that a lot of these things, particularly when you want to front end it, when you want to push it at a great pace, are probably done by the government. And these are all projects which have certainly a positive financial return. But what I'm probably saying is that very quickly, in the span of, say, 3 years, as completion is visible of the project, then take it to the private sector. Sell the project per se, sell the paper, whichever structure, the government could be out of it. Free up the money, and now you are then cycling money in this new institution at, let's say, every 3 years or 4 years, rather than waiting for 8-10 years to get your money back and do it. At which point, the paper issued or the equity issued through this structure would be very interesting to a buyer, and indeed that buyer is a private sector buyer. So I would rather that given our particular challenges in execution risk in our country, that probably the government is best set to take this risk, but very quickly offload it so that you do not burden yourself with funding. So part of that funding can come from this new institution, which is again borrowing from the market. So you are not using balance sheet money, that is the government's balance sheet money, to fund this. Now comes the social projects. For social projects, I think probably, interestingly, universal, these would need to come out of structures which are within the government, that is on balance sheet of the government, because taking it to market, particularly when there is no visibility of a financial return, probably may not be prudent. So what is the modality for this? Probably it needs to be done, and the government has been doing this, is look for very long dated debt which you could use to fund this. And this debt historically has been provided by the multilaterals. You can, of course, blend it with long-term domestic debt and use this as, again, does the funding need to be on the government's balance sheet? Is a very interesting question. Would it not be through a vehicle of the government, which is for a social cause, but the backstop is by the government in terms of providing guarantee on repayment. Anyway, they are guaranteeing repayment by these from these multilateral institutions, but do it through again special structure which takes it off the government's books. So again, I think we need to explore innovative ways in which we can reduce the burden on the government's deficit. I don't want to get into an argument with purists, but what I'm saying is this is done universally. If you dig deep into every country, how they have structured, borrowings from global institutions, and whether it counts in the balance sheet or not, there is no uniform measure. Some countries have been very smart. They make it, they borrow it through a vehicle, and they are distanced from that vehicle, so it doesn't come in the books. And some countries have taken it on the books. In the past, India used to take it in the books, but I'm sure going ahead, we could also be taking it in a structure which is appropriate for that industry or that particular lending program that we have.
Thank you, sir. Very, very interesting perspective. I have read the papers that went to Parliament, and it's public domain knowledge now about the structure of the DFI. But the jury is still out on the larger issue that you raised, is that will it really be taken on the books of the government, or will it be a kind of a hands-off institution which will not be counted as public debt? Now, until that issue is solved, and the issue of access of finance to the extent will the government give 100% sovereign guarantees, etc., are fully clarified, I suspect we will wait to see some of these answers, because in principle the DFI has been cleared, but we are now waiting for the crucial stage, which is the to wait to see it hitting the ground running now. So let's see how many of the issues you have raised get sorted out, but very, very valid issues. So, sir, this automatically leads to the next link in the discussion, which is at various points of time, you have been referring to private investment. You're saying offload the paper to the private sector, offload the project to the private sector, get private sector investment in, as you referred to, in green energy. Unfortunately, there is a general realization now that PPP version 1.0, I don't want to use the word it has failed, because we see many standing projects where it has been successful, including ports and airports and green energy, etc. But broadly, it would be fair to say that it requires serious rectification. And many of the rectifications have been captured in the seminal Kelkar Committee report on revitalizing PPP, which this government, the NDA government, had commissioned. And I think Mr. Kelkar and the infra expert team that worked on the report did a sterling job, because it is probably the most relevant listing of everything that the government can do to bring the energy and the mojo back in what is broadly called PPP version 2. We are standing at the beginning of PPP version 2.0 with a lot of lessons learned. And one could argue that basically in any PPP, there are three constituents. There is the government, which is the sponsor. There is the private sector investor. And there is the consumer, for whom anyway the whole project is being done. In the middle of the triangle sits, in many cases in India and other countries, the regulator. In India, we don't have regulators for every sector. So instead of the regulator, you will probably have the court system. Now, this architecture has to be significantly reworked. And many would argue that each of the elements have not really lived up to their expectations, or to put it in another manner, whether it's the government, whether it is the consumers, whether it is the investors, or whether it is the regulatory system. All four players have much to account for, or much to learn, or much to reset their behavior in version 2.0. Your thoughts on this, sir?
Yeah, I think you have put things in context very well, Vinayak. I will put a perspective on this, which is probably emerging, and that perspective is that there certainly was a need for PPP in the past for a variety of reasons. We will not go down that path. Now, I would think today, let's just look at green energy. Nobody is talking of PPP. They're getting funded. and they're getting on with their life. Ports, the government is shedding what they have, airports in particular. They may keep a wedge, but that wedge will probably have value in due course, and they could offset in roads is where probably there could be other areas. Of course, telecom, again, no PPP anymore. Roads, certainly, because of various values, we would have thought the past PPP was required. But if we are going to go down a path where government itself will front load it and run with the road project and execute it at the speed that they're today executing, then probably I would call this a hybrid model where government does the front loading and running with the project through structures which are funded, as we said, through innovative structures, including this new institution, and borrowings by that vehicle, the vehicle that is set up directly, and then very quickly offloading it to the private sector. I would, it's not a PPP model, but it's a hybrid model where you are building to basically offload. You are building to de-risk the initial risk, which the market probably is not willing to fund in the hands of a private entrepreneur, and then de-risking. To me, this also is a clean structure, because you could then, offload these projects through a very transparent bidding system, which should have no issues that anybody could raise. So possibly, in today's context, we, introducing the PPP structure probably is a little late in the day, unless we find it imperative the government doesn't want to follow the structure where they are front loading and running with the project, and then you have to go in with a PPP model. I think some other type of hybrid model probably will work faster. Not that PPP is bad, but I would think at this point in time we are evolved to probably doing things in some other structures in a faster manner.
Mr. Kamath, what you're alluding to is conceptually a rather interesting point, and this has been debated often by people passionate about infra, including people in the third bank. In developing economies with complex structures of land acquisition, federalism, etc., like we are, what you're saying is, and you've been making this point right through this session today, of front loading by government and quickly offloading to markets. In many senses, this logic thread is running through your presentation. And I would completely concur with this by saying that the purest argument is that the infrastructure sector, the chain has three links: development risk, construction risk, operating risk. What you're really saying is that PPP version 1 offloaded very difficult projects in the first link in the chain itself, which is the development risk. Then it further faced construction risk. By the time it reached operation risk, many of them were half dead. What you're saying now is let the government through SPV, special purpose vehicle structures, 100% owned by the government, undertake development risk and construction risk, and once these two risks are behind us, offload it to markets. Not only will it find larger takers, but it would actually get a much higher valuation, because the bulk of the risk component would have been taken out, sucked out of the project. So I completely endorse this view. It is something that we have been suggesting for some time, and you see live examples of this. I mean, in your own city, the Mumbai-Pune Expressway is a live example where development and construction risk was taken by the government. Construction was awarded in an EPC mode, but the construction phase risk was in the government, and later it was offloaded. The same stuff. So you have a very valid point today that the foundation stone of PPP version 2 should, what you are calling the hybrid model, is really front-ending, taking out development and construction risk by the government and offloading to the markets. Now, that's a very good point, and I'm sure today's deliberations, when captured by the Indian Merchants Chamber, will highlight the power of what we have just been discussing. Now, this automatically leads us to financial markets for infrastructure. Now, this topic is a vast topic. I mean, people have all kinds of suggestions, names, instruments, from the well-known to the most fancy names. I want to ask you three specific questions. there is a common consensus that urban India, and you referred to rejuvenating cities at the beginning of this conversation also, that you will not be able to rejuvenate cities unless you build a vibrant market for municipal bonds. The munis market in the USA is one of the largest bond markets. And not only does it garner funds for municipal corporations and city administrations, it forces them to have financial discipline and rating and collection of user fee charges and all the financial discipline required to take charge of their destinies. So I have a question for you on what would your recommendation be on creating a municipal bond market? That's number 1 out of 3. Number 2 is that the commercial banking system has today been 100% the giver of bank guarantees for all kinds and varieties of infrastructure projects, from earnest money bond to performance guarantee to all kinds of stuff. The commercial banking system has been given, and the private sector complains that finds it very difficult to get bank guarantees now from the commercial banking system at affordable rates. The commercial banking system says it has been bitten so badly that it doesn't want to give bank guarantees because they devolve at the drop of a hat, and then they're left holding the devolved bank guarantee. So the bypass route is to bring in the funding available with the infrastructure, with the insurance sector, and bring in a product called surety bonds, which are prevalent in mature financial markets all over the world. Surety bonds are the insurance sector's equivalent of a bank guarantee. It also brings the insurance sector into playing a bigger role in infrastructure financial participation. So my second question to you is about creating the surety bonds instrument as a normal in conversation as bank guarantees are. We should be talking BGs and SBs, surety bonds, with the same breath. And hopefully, like in the US, surety bonds should evolve to being a bigger market than bank guarantee. Now, last question. In terms, now you see the amount of interest in the IPO market, you see the amount of savings that are coming into capital markets. Is this the right time for tax-free infrastructure bonds for the Indian public to invest in nation building? Here, I'm sure you will have many more suggestions about specific instruments, and I will leave you completely free to talk about them. But I want to lead the discussions by asking you about municipal bonds, surety bonds as distinct from bank guarantees, and tax-free infra bonds for the public to invest in. Over to you, sir.
3 questions. Let me start with municipal bonds. I think indeed well-run municipal corporations should issue bonds. In fact, I would think that Mumbai is an excellent institution to look at in terms of how they're managing their finances. From what I know, the books are managed very well. Again, it's not only how well you manage the books. I think there is ability in a city like Mumbai and in several Indian cities to very innovatively harness more, I would say, funding for itself. And that could be used to defray, or repay whatever you borrow. So if you are able to properly structure what you are going to collect basically on a long-run basis from your city, apart from the property taxes that you are collecting, and then say that that is going to be my cash flow, and my investment is going to be in urban rejuvenation, I think is going to be the way that we will have to look at cities going forward. And this answers that other question that you implicitly raised, Vinayak. Social lending, social projects. Let's take the Mumbai Metro. The Mumbai Metro financially may not be viable, but socially, in a social cost benefit context, it certainly is above any threshold that you can put in. Now, such projects, how do you fund? If it were to be funded by the city, in this case, it is not funded by the city. If it were funded by the city, or similar projects in the city, they were to. And I think you wouldn't replicate it across India. You have two advantages. One, you have development happening, change happening at express pace, and at the same time, all this funding which would have come out of, let us say, the state budget or the national budget is now getting funded through the local budget, and the local budget framers will think innovatively how do we collect money? And so I don't think there is a dearth of available resources. I think probably the ability to marshal it has to be more focused. How do we marshal resources in a more focused manner? It may vary city by city, but almost all Indian cities would have the ability to do this as we go along. So municipal bonds, yes, and I would think that the rating agencies could do a great service by sitting with the municipal corporations and telling them how to structure this, what could be their additional sources of revenue, how could they say, backstop these bonds, and completely dealing them from the state's budget so that they become local budgets which are self-funded. This is one. The second point was on guarantees. It's a very tricky one, Vinayak. Now, what I saw was with guarantees, two things. Historically, guarantees were completely mispriced by the system. I would say that with the sadness that most banks did not understand how to price a guarantee, and basically they were taking on what I would call open-ended risks by providing these guarantees at rates which clearly were going to be above your long-run loss ratios. So the product needs to be reinvented in any case. And of course, now that they have burned their fingers, they don't want to provide it anymore. I would be a little wary of then having the insurance sector take on this role. Again, product, yeah, they have one advantage. They have long-dated ability to support something. But the other inherent risks are the same. They need to price it properly, and they need to make sure that some of the upfront risks are taken care of by the implementer. Now, these upfront risks, you mentioned the three components of a project: development stage, the execution stage, and the operation stage. Now, most of these guarantees come during the development stage or post-development, during the execution stage, where I think risk is alive and staring at you. And it would probably be not prudent to ask the leasing companies, the insurance companies to come in and take that risk. So we need to be creative again. And I would think that creativeness comes out of de-risking this structure by government vehicle in areas where the risk is still highly prevalent. Road, for example, doing the first two bits, and the last bit being done by the private sector. But in the case of, let us say, green energy today, I would think even the first stage is comfortable. And there, I'm sure the structure that you mentioned, insurance companies providing this sort of backstop, certainly should be explored, but at the right price. I think the key is pricing right, because for almost a few decades, we have been pricing guarantees wrong. The second one, price it right and appropriately for appropriate product structures, appropriate end user structures. Yes, indeed. The third point was an interesting point. Should you be offering a tax rebate on infrastructure bonds? My view is that that should be the last resort, because ultimately, the government is then coming into play. Government could do this for an instrument that they are issuing to the public. That's entirely up. But allowing third parties to issue bonds which are tax exempt, I do not think. Having said that, Vinayak, with interest rates where they are, hopefully we will be in a benign interest rate structure going forward, because that is critical to all that we have said. What we have talked of for, what is it now, almost 40-45 minutes, will not stand any test if interest rates were to move again upwards of say 8 or 9%. So all this works in a scenario where we are talking of interest rates at 6 and 7%. I hope it continues, because if we want the 25-year runway, the 25-year growth path, interest rates will have to be. Of course, the signaling from the Reserve Bank is that indeed they would. They have clearly said that at this point in time, they want to keep interest rates in check and liquidity ample. That will have to be the mantra for this long-term growth. So given that, I don't think the funding per se, the funding cost per se is going to be a challenge. The cost will be a challenge for infrastructure projects. So that what would have been the advantage of the tax-free nature? It would have brought down the funding cost. If your bond is already priced low, that may not be a challenge. So at this point, I would not be an advocate of tax-free structures for bonds.
Right, that's an interesting point of view. I'm looking at my watch and I'm seeing that we probably have just another 5 minutes before we start wrapping up the session. I'm going to ask you a lateral question, sir. With your huge exposure that you had recently, looking at China, would you say that India should fast forward the development of coastal economic zones, which in some senses allow the nation to leapfrog out of all the bureaucratic hassles that plague, execution and construction risk by creating conditions of a vibrant international market of free inflow of exit of labor, of capital, of minimum bureaucracy, learning the lessons that we do not make the same mistakes as SEZs. So I'm not advocating a let 1,000 flowers bloom, but maybe focused 2 or 3 or 4 coastal economic zones, 2 in the east coast, maybe 3 on the west coast, built by the government and then factories and plots sold to whoever wants them, but with a completely new, clean, international way of doing business that attracts companies to come and invest and allows Indian manufacturing and operations to be globally cost competitive without all the hassles. So rather than change the entire country at one shot, can coastal economic zones be the new flame, the driver of the art of the possible? And this will be my last question to you, sir.
Yeah, I think clearly we have seen that across Southeast Asia and across China, as you mentioned. Again, my own view is that it should be government owned as a separate vehicle, borrow separately, have equity in it, and then at the right time, how you want to monetize it. But it will have huge value when you monetize it. So be conscious of that value and then monetize it. But the key, as you said, is the mindset. The mindset as to what and how this zone will be run is going to be key. So that it is not tested against what you do or what you have been doing, but what you want to do and what you will do new is got to be the mantra. Having said that, Vinayak, I would think there is such a lot to do in this 25-year look forward runway that all these are what I would call momentum providers in that path. But a whole lot of simplification, a whole lot of easing is still required. And I'm optimistic. People say, oh, there are constraints in India. Our Indian entrepreneur has lived with the constraints, not 5 years, not 10 years. He has lived with this constraint for 50 years. And he knows how to do business in this context and thrive, and knows what are the challenges that he should avoid. For example, over leveraging, just talked about earlier part of our session. So I would think that you create an environment for him to run faster, but this country will grow on its own, along with new structures, new economic drivers, and indeed amalgam of driving manufacturing, driving services, driving infrastructure, and indeed the digital super cycle, because all these things are what I would call fresh air, fresh breath for this country.
Thank you, Mr. Kamath. I suspect that draws our this scheduled discussion to a close. I feel particularly happy that in this 1 hour given to you and me, we have been able to cover a vast amount of ground. From 25-year vision to public expenditure to DFIs to economic returns, financial returns, SPVs, monetary, financial instruments, etc. We've covered a vast amount of ground, and we've actually got some very, very interesting insights from you. Not only on what we should do, but on a few things we need not rush into also. I think that's as important as making a list of things to do. So I'd like to thank you very much, Mr. Kamath. And I would, if you have any last comments to make, please do so, because I would now step back and hand over the session back to the organizers.
Yeah, I just want to thank you, and I want to thank the hosts for what appears to have been a very well run 2 days, and wish the chamber lot of opportunity growth in the forward. They have been, of course, there for a very long period of time, and I wish them well the journey forward. Thank you.
Thank you, sir. Back to the organizers, please.
Thoroughly enlightening fireside chat, and I thank Mr. Kamath and Mr. Chatterjee for the same on behalf of IMC Chamber of Commerce and Industry. Let us move on to our next session, and this is a panel discussion on building and scaling world-class platforms. Panelists are Mr. Ajay Kaushal, co-founder and director, BillDesk; Mr. Anish Achutan, CEO and co-founder, Open Neo Banking Platform Company; Mr. Chaitanya Adappa, head Udan Capital; Mr. Samarth Bansal, APAC head of WISE, formerly TransferWise. This session will be moderated by Madam Mridula Iyer, Managing Director, Head Treasury and Trade Solutions, TTS, for Citi South Asia. Ladies and gentlemen, the agenda and profiles of the speakers are on the bottom right-hand corner. You know that by now. And as mentioned earlier, due to paucity of time, I will not be reading out the entire profiles. You can take a look at the bottom right-hand corner for the same. If you have any questions, you are requested to submit them in the Ask the Question section on the bottom left corner of the screen. Please specify the speaker's name to who the question is being addressed to, and don't forget to click on the submit button once the question is typed in the Ask the Question section. Over to you, ma'am.
Thank you, Mansi. Hello, everyone. A very warm welcome to all my panelists and to all the participants. I want to thank IMC for this opportunity, Mr. Podar, Mr. Basu. I think an extremely well-run session with a good line of speakers. We are on today's panel, I think we're going to further the theme that we are talking about, which is really on how banking and finance is going to get transformed over the next few years. It's just that I would say that today's panelists will give it a little twist to the whole discussion because I think I'm joined by people who, in my view, have actually led the transformation that we have been discussing in a very large way. They have been a catalyst to this whole change. In fact, they are the ones who have sort of embraced technology in a big way and use technology to accelerate this whole change. And I am talking about entities like various platform companies, neobanks, payment companies, and some of them are being represented on the panel today. I have been a banker for the last 25 years, and I have seen this transformation happen in a slow and steady manner over the years. But of course, I've also seen the acceleration in the last, I would say, 5 to 7 years, if I can say, and largely led by technology and new business model and changing consumer preferences. What is amazing about what these entities have been able to do is how they have been able to expand this entire ecosystem, get financial products and solutions to those who previously did not have access to, like those who did not have access to credit, those who did not have the ability to understand complex financial solutions. These entities have simplified it to a very large extent and ensured that more and more people have got access to financial products. So on today's panel, we will obviously be taking their views on how they made it all happen and how they see the future of banking and financial services. The second aspect that I would like to touch upon, and this is a lot that we as bankers, I think we get to hear often, and I've heard this quote even on this session, that in the future we need banking, but we don't need banks. And I think one unsaid comment can also be that we don't need bankers. But I have a slightly different take on that. Having spent about more than 2 decades in the banking industry, I think banks will continue to have a strong foundation in how financial services get delivered. But like every other ecosystem where we have seen that partnership and collaboration can be a force multiplier, I would think that even in this segment, with partnership with these new age entities, we will be able to bring that force multiplier and expand the ecosystem and bring these financial services to a lot more people, both individuals and corporates. So with that, I would obviously like to take my panelists' views as well on that. We can jump straight into the conversation. But before we get in there, I'll just do a quick round of introduction of all the four panelists who are joining me today. Uh, Ajay Kaushal. Ajay is the co-founder of and director of BillDesk, which is India's largest electronic payment platform. Ajay co-founded BillDesk in 2000, and I think from there on the company has really grown strength to strength. And prior to BillDesk, Ajay worked with SBI Capital Markets and Arthur Anderson. Welcome, Ajay. Chaitanya Adappa. Chaitanya Adappa leads the NBFC business as Udaan Capital. Udaan, as we know, is the largest B2B e-commerce platform, and they have done some fantastic work in meeting the working capital needs of MSME in this country. Chaitanya has been associated with Udaan and Fiscal previously. Welcome, Chaitanya. Anish Achutan, he is the CEO and co-founder of Open, which is the neobank. Anish has been a serial entrepreneur, and I think in the last 17 years, he has founded many companies based on various problem statements. And before that, he was the part of PayU India founding member team. So, Anish, welcome to the panel discussion. And finally, we have Samarth Bansal. Samarth, thank you so much for joining us from Singapore. It's late evening out there, but thank you so much for being a part of this panel. Samarth Bansal is the APAC head of WISE platform. And Samarth has been very focused on working with FIs to building partnerships to ensure that cross-border payments can be kind of made available in a very cost-effective and speedy manner. He has previously been associated with an AI-driven SaaS company and also worked with Goldman Sachs. So thank you so much, gentlemen, for being part of the panel. I would like to start off, and maybe Anish, I will just start with you. You now run Open, which is the neobank, and before that you have run many ventures, all based on technology. So of course, technology has driven a lot of these new ventures. So what are your views on how technology is shaping how financial services are being provided? And what exactly is the role of neobanks, right? They are coming up as challengers to traditional banks. So what exactly is the role that neobanks are playing in providing these financial services to the ecosystem?
Great. Firstly, thanks, Mridula, and thanks, IMC, for this opportunity. So, Mridula, I would start with probably what, in my little experience, how I had actually seen this industry shaping up. So, in the early 2000s, it's more about initially banks starting offering payment gateways, and then later the likes of like the BillDesk or the tech process and the CC Avenue. That transformation happened, and towards like the 2010, then nobody would go to a bank for a payment gateway. Mostly would actually go to that. Then came the next the issuance game, like the prepaid cards being issued, or the Paytm, the wallet started, and obviously we all know like the UPI happened. And this is what I would probably call it as a fintech 1.0. And then suddenly we see a huge transformation, whether it in terms of lending or the entry barriers of financial services, because earlier banks used to work only with certain few privileged legacy larger players, but you had seen like more startups or so-called fintechs, basically the financial technology companies, which were able to create more innovative solutions, which was initially, I would say, from 2015-16 onwards, driven a lot by lending startups coming up, basically, and then started moving towards whether it is like players like us in terms of neo banking services, and later the other things. So this is what from a fintech side, what is the transformation in a very 30,000 feet, which I had seen. Now, in terms of specifically on the question of like neo banking and what does how does it is transforming the ecosystem, I would say we are still in a very nascent stage of the so-called neo banks. Probably it all started, the wave started with the Europe and the US. There, the traditional legacy banking system was so bad that okay, even if like a slight change in the consumer experience, people would actually shift to like a newer entity. But India is a lot different. our banks are like better, have better user experiences, better the thing compared to the peers in the thing. But so the way in which the adoption has actually happened in those markets may not directly would have happened in a market like in India. But what we found was that, especially in areas like, why we started with SME, because we thought like there's a lot of challenges which MSMEs has to face through when it comes to the traditional business banking, because a lot of focus has been on the retail banking, but when it comes to business banking, many of the banks even didn't have a mobile app to start with. But more than the banking part of it, a lot of businesses needs to interact with a lot of third-party services like an account payable services or accounting services or tax systems, and or even for collecting online payments, you have to actually rely on online payment gateways, and all the systems doesn't talk to each other, which resulted in a lot of time and energy going reconciliation the systems. And that's where we thought like, okay, maybe there is an opportunity to bring all of them together. So that was how we started on these things. However, over the last few years, considering with the global trend, we have seen a lot of new banking players coming up both in the consumer and the SME side. And my view is that, like the way consumers have adopted a Google Pay or a Phone Pay instead of the bank's own app for making a UPI payments, slowly the Indian consumers will also start looking at at some of these neo banking services, both on the consumer side and the SME side. And a lot of this would be happening in terms of collaboration between this fintechs and the banks in building up these platforms as well. And we'd also see the banks like, for example, SBI's, or like some of these banks also directly launching this this kind of interfaces and the services and winning in this space.
Thank you, Anish. When we were talking, you mentioned that you open like 50,000 sort of accounts in a month. That's a very, very large number. And it's a very unique model that you have for client acquisition, right? So I'll come back to you on how you have managed to do that. I'm sure a lot of this is technology driven. But right now, if I just go over somewhat maybe to you, and again, see, you are trying to solve another age-old problem that we've been kind of saddled with, which is really cross-border payments, right? And how do you make cross-border payments more cost-effective, speedy? How do you get the information out to the remitter and the beneficiary? These are problems which we have struggled to solve for. Now, Wise plays a very important role there. So share with us your perspective on how you've seen this space evolving. What have you been able to do better than what the traditional banking setup provided? And how do you see this whole thing being beneficial for consumers, whether it is individuals or for businesses?
Absolutely. And maybe I'll start with the last thing first, right? In terms of what value customers, businesses today are seeing from this, and then backtrack towards what are some of these inefficiencies that have allowed us to do what we're doing today. So I guess taking everyone back about 10 years when Wise started, it was started very simply by our founders, Tavit and Christo, realizing the amount of cost that they were paying in exchanging foreign exchange with traditional channels, namely our banks, right? Tavit was based in London. He was getting paid in euros. Christo was based in euros and had a mortgage that he had to pay in euros, but was gaining salary in GBP. So essentially what they realized was the other person had what they needed. So instead of going to the banks, they essentially decided to just exchange the funds, and they had to decide on what the FX rate was. They Googled it, went to the Reuters mid-market. That was the fairest exchange rate, decided to do that and navigate across all the hidden fees and the large fees that banks typically charged you when you were doing remittances. So that planted the idea, and they realized that millions of customers around the world would have a very similar issue, right? So they started building to try and solve and remove this hidden fee, the inefficiencies that exist today in moving money cross border. So that's where it all started. Now, as customers, as consumers, we also tend to be founders, managers in SMBs and small enterprises. And soon they realized that this problem is not just limited to retail, but also to SMBs, right? So we started solving for problems in cross-border remittances now more broadly from retail to SMBs. In that journey, what we realized was it's not just remittances, it's also anything to do with international money movement. So whether that's spending money, whether that's receiving internationally. And so the entire international money needs is what we are solving today through our global infrastructure, and also exposing that through APIs. Ultimately, the customer gets faster, cheaper, more convenient, and transparent international transfers. Now, you raised a very pertinent question on how have we managed to chance upon this? Was there something magical that we did? And I think the true answer is that you need to contrast with how cross-border money movement happened in the legacy infrastructure, right? It happened through a multi-hop process. So the originator bank would have a correspondent, would have an intermediary, and then would have a recipient bank. And so there was always this multi-hop process. And as banks, from a legacy standpoint, would do this either on their own batch processing timelines, would have fees that they would charge, would have their own checks that they're running. And so the originator bank tended to lose visibility on where the funds were, and all of these inefficiencies across the value chain, across the money movement kept getting added either to the sender or to the recipient, right? What we've done is, and I think Anish mentioned this, there's been so much advancement in the domestic payment systems, right? There have been, India's got UPI, in London you've got the FPS, SEPA Instant. So there's been a lot of innovation in the domestic payment rails. And we have essentially broken down this multi-hop process and made it to two domestic transfers. We collect the money in a market using domestic payment rails that are very well oiled, extremely efficient, and make the payout in the recipient market, again, with those same efficiencies in the domestic money movement mechanism, right? So what we are doing is we are building this, we are engineering away the inefficiencies that exist and connecting the domestic payment trails and setting this new standard for international money movement. So that's essentially how we've managed to get here. There are multiple steps that money movement takes, right? You need to solve for the front end. How does the customer make out a payment? For a lot of banks, it's still in branch. They don't have the digital channels, the convenient ways to initiate transfers. They then have to create a recipient, which could be 100 field long, depending on the messaging systems that are being used. They then initiate that transfer. The banks have to do multiple checks. Cross-border remittances is a regulated space. And so they would go through that multiple checks, to process that payment, hand it over to the next leg, and so on and so forth. All we're doing is we are building out this network where we have end-to-end visibility, which gives that transparency back to the customer.
Thank you so much for sharing. Again, as I was saying, that it is really use of technology, but at the same time, how new models are emerging. What you've really done is you've taken a monolith cross-border wire transfer and broken it up into multiple pieces, with more having a domestic leg to make it more efficient, right, and to make it more cost-effective. So yeah, it makes sense on how kind of you re-engineered the whole process. We'll come back to you, Samarth, on where do you see partnership with banks, and especially since you're kind of heading that particular area for WISE. But right now, if I can just move to Chaitanya, and Chaitanya, Udaan has been a great example of what we have been able to do in the B2B space. And I think the entity which you're heading is specifically focused on credit and making more credit available and accessible to small and medium enterprises. Now, this was always the domain of banks or non-bank finance companies. No one would have imagined that a tech company could come and sort of, disrupt this space. So it'll be interesting to hear your thoughts on how did Udaan make this happen? How are you looking at the whole credit piece, and how has the journey been so far?
Certainly, Mridula. Thanks for having me here. Hello, everyone. Mridula, we started 5 years ago, and we started with the recognition that there was a large part of the Indian mass consumer market which was unaddressed by the B2C commerce, which was already which had already been around for a good 5-6 years by then. And we all come from e-commerce background, the early team, and we had a sense that that there was an opportunity to address the mass consumer market through the Indian retailer, right? Through solving the problems of the Indian retailer. And the Indian retail, Indian retail is very fragmented, geographically dispersed, and we felt that it would make for a good e-commerce driven play, right? And that was the genesis of Udan. We had a general sense that there was an opportunity here that we should address. In the initial years, in the initial few months rather, a lot of our work was around meeting customers and trying to talk to them, small retailers, and trying to understand what their problems were. And the themes that came up were access to high quality supply, large product assortment, competitive prices, fast shipping, and credit for purchases. Right, the working capital was a very integral part of the problem statement from day one, and most business transactions, credit tends to be a part of the terms of trade itself. Right? It's as integral to the transaction as the price or quantity. Right. So we had that recognition from day one itself, and at that juncture, we decided that credit is going to be a first-class construct on the Udan platform, and we wanted to invest in that space. And since then, we have explored different themes, different products, different interest models, etc. And it's been a journey of trying to figure out how a credit product would look like when it is particularly focused on enabling trade. Right. So that was the problem statement that we went with. We wanted it to feel as natural to the retailer, to the business buyer, as credit from a wholesaler or distributor would feel to the borrower, right? So it's as natural as that, and we bit by bit we designed the product to feel that natural to the user, and from an capital sourcing standpoint also we've had a journey. We have our own NBFC where we finance our borrowers by raising debt from the market. But increasingly, we also work with a lot of banking partners and larger NBFC partners and enable them to plug their capital into our working capital financing products for our users, right? So we actually see ourselves not as a lender, right? We actually see ourselves as a platform that's trying to enable flow of working capital from different financial institutions into businesses, into the SMEs particularly, right? So that's the way we see. That's the way we see it. We are fortunately, because we have a very close view on what the user is doing, the borrower is doing on a day-to-day basis from a buying and selling standpoint, and because we also have a strong presence on the field and field level connect with our borrowers, we are uniquely well positioned to be able to do that, and that has helped us a lot in the last few years. And so that's been a journey so far, right? And we are looking to build upon these strengths and further enable our customers to get access to formal financing, even when they're buying from suppliers or vice versa.
Thanks, Chaitanya. I think the point that you make is very interesting, where I think banks have also started going in that direction, is where you're using data and the past behavior and every other information about the flow that you have with you to make credit decisioning. And I think that is what is critical when it comes to expanding credit in our country and making it available to the smaller sections of the society, the smaller businesses, etc. It's interesting as I hear to all of you, and Ajay, I'll come to you, and I've known you for a long time, so I know you built your enterprise based on a problem statement. But it's interesting to see that how each one of you has picked up a problem statement that came from a traditional way of providing banking service, and then have sort of built on that, right? And kind of deep dive into the whole solution, and then developed a model which sort of tries to overcome the problems which were there in the traditional way of delivering that service. So Ajay, as I move to you, you were one of the oldest companies, I think, to have looked at the whole payment ecosystem in the country, identified certain gaps and inefficiencies in the way that payment was being delivered or customers had access to payment services, and then sort of built a business model around that. So why don't you share your journey with us and how Buildus has been able to kind of also bring about digitization and payments in a very big way in this country?
Yep, thank you, and it's good to be here. And I think you have a tough job. You have 4 people who are out to take your business. So I think you have to do work really hard to make sure that you keep what you got here when you came for the panel, because you have somebody who wants to take away cross-border. There is somebody who wants to take away lending. There is somebody who wants to take away your interface, and there is somebody who wants to take away payments. So I think it's an interesting group of people you have, and yeah, like you said, we started this way back in 2000, and until a very long time, we used to pride ourselves that we actually created revenue where revenue never existed for anybody. And we also ensured that whatever segment we went to, it was a segment that created a revenue line for everybody in the chain. And we unbundled. And actually, if you see all of us on the panel, we've been unbundling a part of the bank. Somebody's unbundling, trying to unbundle credit. We unbundle payments. Somebody's unbundling cross-border stuff, and this has been happening for the last 20 years. What we are seeing today is the rebundling, and because these unbundled entities have acquired some sort of scale. If you see the world over, there are enough large payment companies. There are reasonably interesting cross-border companies which have also come up. There are a variety of people testing lending in different forms and shapes. There are people testing the brokerage or the wealth tech kind of solutions, apart from all the other things in banking. So our journey also actually mimics some of these things. As I said, we started a little early, and we ensured that we built relationships with all those people who were well entrenched there, which is the banks, and which is large. Because at the time when we started, e-commerce wasn't the name of the game. It was large utility companies, mutual funds, or insurance companies. So we grew with those kinds of businesses and helped them digitize their offerings. Over these years, a lot has happened, from a simple payment which used to happen offline to cards to, I would say, internet banking to UPI. I think Anish spoke about it. A lot has happened, and I think we are at a stage where today, from a bank's perspective or from banking perspective, I think the entire technology will get rewritten over the next 5 years. And we've had this conversation, Mridula and I, that I think the banks are going to, or rather the banking sector will see a complete refresh. And I also mentioned to Mridula that I think Citibank has a smart move by deciding to do this 3 years before others will figure out that, times have changed and we need to rewrite the back end and come back with something which is simpler, smoother, and smarter. So I think that change has begun. And whether it started with payments, because I think, payment is the simplest thing to attack, and it is the most universal thing, because for everything you need payments, whether you are paying taxes, whether you're doing mutual funds, whether you're doing loan repayments, whether you're buying anything. So you need payments everywhere. And it's that interesting point where actually you finally decide the value transfer takes place. So you can capture a lot of information. It's not intent, it's an actual thing that takes place. So a lot of people have started from payments, and the world over, they're now rebundling. Similar things are happening in India yet. We have not scaled up to an extent where the rebundling is becoming relevant. But if I take our business, we will do close to, or rather we would do over $100 billion of payments this year. We would touch transaction volumes, annual transaction volume, which will be somewhere in the region of 3 to 4 billion transactions. So there is a fairly scaled business. And I think what we will see, and it's a very universal thing. India is, in my view, way ahead of most countries in the world as far as payments is concerned. The efficiency, the cost. I have a very different view on cost, though, but cost is pathetic. If cost is pathetic, imagine revenue must be really bad. So that's the challenge here. But I think at an overall level, the unbundling will happen. I think the infrastructure, or rather the backends and the platforms that the banks use will, rather financial services players use, will change. And I think that's the exciting thing that will happen over the next 5-7 years. See, nobody ever goes away. If you take even travel, everybody said that the broker will suffer, but the next guy, the technology guy is also a broker finally. So I don't think that the form changes, the entity remains the same. We might be more tech driven. Like I think if you talk of TransferWise, it's just the traditional Hawala that used to happen in India all the time. That's how we move money between Bombay and Delhi today. You do the Bombay thing in Bombay and you do the Delhi thing in Delhi, and we just settle net after that. So I think you'll find smarter ways to do these things. And I think the people who benefit from this transformation will be different. I think to your point, how banks or existing players can cooperate or engage, I think that model has to be found, because there is no great successful model yet for an engagement of this kind. Because the fintech actually wants to do fin, not tech, because tech is given, they want to do fin actually. So I think we'll see what happens. But till now, from our perspective, I think we've seen payments scale up really well. We see there's still enormous growth in payments because it's a very universal thing. Unlike in most parts of the world where payments is very consumer centric, I think we managed to make payments more universal, because whether it was mutual funds or taxes or utility bills or commerce, I think all of it has become part of it. Even B2B payments, I think we did some work with Citi earlier to even manage B2B payments in on our platform. So I think the opportunity is really great. I think the rewriting of financial services back-end and front-end will happen over the next 5-7 years. And there are enough people who are sitting on this panel who will benefit from this change that's going to take place. Thank you.
Candid as always, Ajay, and you and I will keep having this divergent view on whether you guys need banks or you can operate pretty much on your own.
So I just want to tell people that I keep telling Mridula that her building in BKC will not be there in 5 years in Bombay.
And I have still invited him on this panel, so that says a lot of. But thank you for those comments, and I think that kind of I do not disagree that banks have a lot to sort of reinvent and adapt and pivot. I think we have our own issues around legacy infrastructure, maybe regulatory, supervisory compliances, and how quickly we can pivot. But as we heard Standard Chartered yesterday, and I know from my own experience with Citibank, we are going digital in a very big way. And today the investments are all there in the new technologies. And I think the biggest change in the thought process of banks is previously we wanted to build everything on our own. But I think today we are very open to partnering with entities like yourself, because that just shows that you can jointly make the solution so much more powerful for your customers, right? And that's what I think that's a good segue for me to get into the next part of our discussion, which is really on how do you see partnerships with banks and other entities kind of helping make this space more formidable in the years to come? And maybe Samarth, I'll start with you, because again, cross-border, I think always been the domain of banks for many, many years. And you see yourself as a challenger there, or you see more banking and other financial institution as a more collaborative partner. So how do you see that space kind of emerging?
Yeah, so that's a very good, and we were thinking about this, right? Because from our perspective, what we're seeing is customer expectations, preferences, all of that is changing, right? That's moving at a speed which requires all of us to be on the top of our games. All of us need to continue to understand what are these new use cases coming up, what are the preferences that customers, consumers, businesses, enterprises alike are requesting of you, and continue to move towards that. And in that process, what banks like Citi and some of the others across neobanks, across incumbents, across larger platforms are realizing is the question for them is fairly straightforward. Are we able to innovate at that speed? Are we able to keep our platforms future proof? Or should we partner and work to solve for what our customer needs and expectations are, right? So that's the drive that we are seeing today, and the shift, which has only been accelerated in the last year or so. And so what we're now doing is taking this infrastructure that we've built cross-border, sometimes by directly connecting into the local payment rails, sometimes by working with bank partners that have been very focused and have a very good domestic stack, like you mentioned, Ridhila, like a very monolithic stack, and building on top of that, and then also offering this global infrastructure for other incumbents who don't have access to this, who don't have the global reach or the ability to really go in and build out these bilateral, mutual, correspondent relationships, right? So that's essentially how we see the partnership evolve. A prime example is something that we did with Shinhan Bank, right, which is the second largest bank in South Korea. Now, they realized very quickly that their customers were expecting a very different experience, a very different proposition when it came to sending money cross border. They also realized that it was really difficult for them to build out all of the streamlining that requires to be done, really get into changing their core, changing their payments infrastructure, building that out to be a high STP rate process so that these inefficiencies that ultimately impact customers are taken away. And so that's where we, having built this over the last 10 years, stepped in and were able to build a partnership that worked for the bank, that worked for their customers, and also worked for Wise, right? So I think that definitely is the model that we're seeing going forward with a lot of neobanks, with a lot of incumbents, as well as larger enterprises who are looking for that efficiency, but are also looking for that efficiency now.
Thanks, Amar. And Anish, I think same in the neobank space, right? Because technically you're not a bank, but you are someone who's bringing the full range of banking and financial services to clients. So how do you see this whole partnership playing out and, transforming this in the years to come?
Right. So maybe we'll take a. So I think the bank collaborations probably again it started initially with the powering payment gateways, and after 2010 is what we had actually seen, like the likes of RBL and Yes Bank becoming more aggressive in working with more startups to launch their own services. And what we have globally also, if you have seen, like in the current transformation, where a lot of banks have taken an approach, or they realize that banking as a service, or like I don't want to build everything, but I can be the platform that powers other business models, and that been fairly successful basically, and a lot of banks are now moving towards that direction as well. Even in India, for majority of the banks which we work with, I have seen a transformation last 3 years. There are like banks which have now put up like a larger 100 to 150 member P&L unit for banking as a service, basically working on building the newer APIs to support this kind of a fintech models as well. So I do believe that a lot more banks will actually move towards the platform as a service model, and those are the ones which actually emphasizes this on early can be fairly successful. And in terms of the partnership, there are also banks which have taken the approach of like, let me build a digital bank basically to compete with the fintechs as well. Now, from my experience, like when some of the panels which had earlier attended in last year, I think it was Stancy basically, or somebody was talking about creating a digital bank. They put up the entire employees to wear T-shirts, put them in a co-working space. But when it comes to the regulations, it's the same old, legal and the compliance team is actually doing that, right? So they're not getting the flexibility enough as well. So I think banks will work more towards it. The other part was like what Ajay mentioned, like as banks will also now start looking at improved technology stacks, and there are like players which is specifically working on helping that. For example, Wise for banks, basically the objective is to empower banks to compete with fintechs, or like take up these opportunities, right? Or Zeta for in the market. Even for open, while we have the direct to customer SME banking, we have white label this for the top 15 banks in India, basically, where each of the banks then would call it as under their brand name as well. So the collaboration as a model is what I would see where both benefits. There could be winners as standalone players as well, because as the world moves, maybe there could be standalone licenses that is coming in. Some of them would succeed. There would be banks which has taken an approach, like for example, SBI, for that matter, is a good example where that actually built a completely digital bank, a legacy bank taking into that. And there are the likes of like what the ICICI, Yes Bank, RBL, which focuses saying that okay, I wanted to be the platform and to power the fintechs. So these models will exist, is what I do believe.
Yes, thanks, Anisha. I think That is, I think some banks have embraced this faster. The way they have kind of started working, incubating fintechs, and then giving them the platform wherein they plug in their services and white label it so that the banks can make it available to the customer. I think we've seen many successful use cases of that in the Indian banking industry. If I can move a little bit, Ajay, to you on of course, a partnership is there. We have seen lots of use cases and business use cases around this, but I still don't think it is exactly a level playing field between fintechs and banks, right? And then, of course, your views on how we can come together to create maybe more digital solutions, more digitization push in the country. Do you think any policy level changes are needed or anything in the ecosystem that needs to change dramatically for us to get that acceleration in digital payments? Of course, I think we've come a long way with UPI and every other digital channel. Now we have NEFT, RTGS, everything 24 by 7. ACH becomes all day in another month's time. So I think India has leapfrogged as compared to any other country in the world. But do you think we need to do more? And is there chances of collaboration between banks and digital companies on that front?
So I think there is definitely opportunity and need. I think it benefits both. And our experience over the last so many years has been that it is better to collaborate than to unnecessarily compete, because then we are competing for the same space. Because eventually, if each one of us has to become a bank in 5 years, we will be only be maybe a newer bank. That's it. As in, we might have a newer backend or a more shiny backend and a faster backend. But I would think that, and that will take time. And therefore, I think the opportunity to engage with existing players, make them do their things better, will be a faster and I think a better value creation proposition for the system as a whole, rather than go through this process of, I would say, when you unbundle, you primarily kill that commercial model in that space. If you see over the last few years, whenever somebody tries to unbundle, you first kill the commercial model. And when you rebundle it back, that commercial model never comes back. Because, your cost is my revenue. And that cycle continues. And if we are perpetually going to be reducing cost, we are not going to create enough revenue in the system. And we have that problem. And payment suffers from that, where everything is very good. Money moves the fastest. Money moves 24 by 7. Even 50 rupees moves and settles instantaneously. But nobody makes any money in this. So it's such a sad thing. We do billions of transactions. It's only cost. So I think, and that's an outcome of competition between the new players and the existing entities. It's this competition that actually gets people to bring down. See, you have to make things more efficient. Definitely, yes. But do you need to kill the commercial model before it attains a certain size or scale? I don't think so, because businesses need revenue, employment needs revenue, and if you say that I'll make this free, and then start killing the cost side. First, you kill the revenue side, and then you say, okay, now let me start squeezing the cost. And that's the model that we have followed here for a long time, whether it's financial services or anything else. So I would think that under the air cover of existing organizations, you can protect the revenue model. You can make it more efficient. You can maybe create more value in the system and then distribute the value, rather than first kill it and then try to kill the cost side, because then you've killed both. You've killed the revenue also and you've killed the cost also. So I would think that it definitely makes more sense to partner. And I think there is opportunity to partner. But I think the greed is that if you own the customer, you can always sell something else to that customer. I think that greed gets people to want to own the end customer and not be a provider of services. So I think if we can get this model right, where a provider of services can also benefit in a reasonable manner compared to the owner of the customer, I think we will get this model right. Otherwise, we will have enough value loss along the chain in India. If I was to compare in other parts of the world, is that the payment ecosystem, which we understand reasonably well, there has been no change in the revenue line of payment companies. Everybody still earns the 2.5% that they earned 10, 15 years ago. In India, we don't. So we have mastered the art of destruction first, and then trying to build value. I think if we can manage this art of creating value alongside and making things better, nicer, and smoother, it would be better. And therefore, I would tend to be on the side of engaging and building partnerships with existing organizations, making things more efficient, and then also being able to deliver at scale. That's the model, and that's the model we followed actually all these years. We've been more friendly to most large organizations, and we have some of the largest banks or mutual funds or insurance companies who've been partners with us for more than 15, 17 years. Right. So we've I think it works, and it can work in a commercially better manner, I would think, for everybody, rather than going and taking a frontal position in the system and saying that I will own the entire chain. So I think partnerships, definitely, I would be a votary of partnerships. It helps create, I think, more value and for more people in the chain.
So on that point, Ajay, I will have to agree with you. So at least that's something that we have common ground, we have agreement on. I think to build, and the way digitization is going on in this country, I guess the tech ask and the need for a robust tech infrastructure is just going to go up. And it is an expensive infrastructure to maintain and run on a day-to-day basis. So therefore, we all need a commercially viable model. And that's where I think the partnership becomes even more relevant. We kind of fill in the gaps that each one of us has in the way we are delivering the service, and we can come together to deliver a more robust solution, right? So with that same thought, Chetan, if I sort of move to you, this whole credit model on a tech platform is still sort of emerging in this country, right? I mean, it's a new thing. We've had payments which has been running for like many years now, and it's a well-tested model. But the credit one is a bit new. So how do you see that scaling up? I mean, do you see similar challenges to come as the payment providers have seen, the non-bank payment providers? I know the infrastructure like OCAN, etc., is still coming up, which will make credit decisioning, etc., very easy. But it also means huge investment in technology to build that sort of a real-time decisioning infrastructure. So, how do you see the credit model evolving?
So, Mridula, platform-based credit is uniquely positioned to solve for some of the credit penetration problems that we have seen in the country, both on the consumers front as well as on the business front, right? Like India, we have, for the past several years, our penetration levels of credit have been lower than what you're seeing in other economies, right? And we are a small ticket economy. We are a small wallet economy as well, right? Our consumer spends are, per user consumer spends are fairly low. And all of that essentially means that there's a large segment of users who are unserviceable with the current some of the traditional models of deploying credit and servicing it. Right? And what platforms and some of the technological changes that actually enable platforms to come into existence do is bring down the cost of both deploying as well as servicing credit materially and help increase the penetration of credit, right? Like to give you an example from Mudan, right? Like we actually lend to a large number of small retailers, and these are ticket size of 30,000, 50,000, etc. Now we are able to bundle their experience of both onboarding as well as collecting with a lot of the platform related activities. For example, right? Our delivery executives would visit the shop almost 5 to 6 times a month, right? So that's a very clear monitoring of what's happening at that shop. If that shop is closed for a couple of days, I know that something is off, right? And it's not a no extra cost to me because I anyway have to deliver and charge something for the delivery, right? For example, I get a very neat trail of all this guy is purchasing and what kind of returns he's raising, right? and I get multiple touch points with the customer for him to get him to get onboarded onto credit. So all of that helps me bundle the cost of deploying credit into the pre-existing cost of just running the commerce platform and deliver credit to these users in a very uh, uh, at a high level of penetration, right? So uh, so I do feel that there is platforms and credit, particularly trade platforms, transactional platforms, and credit have a very high level of complementarity. Uh, and as far as you know, uh, as far as the point that you raised around will monetization potential exist in this business in the longer term? Uh, it depends upon the kind of moat that you have built, right? Like as a platform, because you have some scale economies both on the supply side and the demand side, right? And you tend to have a certain sense, a certain network effect and certain economies of scale going for you, which kind of protects your revenues, right? Uh, as long as the business has some of these elements of defensibility built into them, and obviously there's compliance risk and regulatory risk, and as long as those don't play out, I do believe that the monetization potential of the businesses continue to exist. The problem comes when the business is either commoditized or reduced to a commodity because of external action, regulatory or compliance-driven actions. That's when it becomes really difficult to protect your revenue streams. Uh, Having said that, Ajay is a pioneer in this space, and what he's been doing this for almost 2.5 decades. I'm not sure if he remembers. I met him almost a decade ago to learn the basics of payments. So I would defer to his view at all times on these pieces.
His view is a bit radical, and he would be happy to express it on this platform, but I'm going to hold it back for now. Maybe with this, we just come to the sort of a last section of our discussion, right? I mean, as I said, that all of you have sort of picked a problem statement and then sort of built such a fabulous business model. So it just goes on to show that you have been able to see what the future trends are and how things are shaping up, right? The consumer needs, what's going to happen, how technology is going to support that. So, in line with that same theme, if I were to just go around and ask each one of you that what do you see the biggest change that we can expect in the next 5 to 10 years, right? Whether it's a consumer trend, tech trend, and what is your general feel on what businesses? And we have a lot of businesses which are represented on the IMC platform. If you have any thoughts for them on how they can kind of cope and stay ahead of the curve when it comes to the future trends. So I don't know, anyone, maybe Ajay, you want to start with and then round.
Certainly, thank you. So, I think the biggest trend is information asymmetry going away. I think anybody who creates a marketplace, anybody who says, I will make things simpler, faster, I think the first thing that people are doing is they are making things more and more transparent. And as things become more and more transparent, the traditional way to make money has to change, because information asymmetry is what creates your ability to trade. And if information is going to keep getting more and more commoditized and easily available, I think a lot of businesses, which is including ours and people on the panel and IMC, I think this whole information asymmetry going away will be a challenge, because it will remove profit margin. So I think that is the big shift that will happen and it's already happening, because when you buy something from any of these online platforms, e-commerce platforms, you can compare and contrast prices, and eventually you end up in most cases buying the cheapest shoe, because you know the model, you know the phone, so you end up buying the cheapest thing. Similarly, in credit, I think as models like Oken and others come up, they are again going to remove information asymmetry in credit. So again, credit margins will begin to get impacted, and then you have to find some other ways of making money. And I think one of the ways then can be scale, but then India needs to have that much of consumption so that you can then benefit from scale. So I think for businesses going forward, this big shift where things become more transparent, our way of earning and spending and benefiting has to change. And for businesses, I think to understand that this is a trend that will not get reversed. Things will keep getting digital. It will keep getting easier to access information. And in that environment, how do you come up with commercially beneficial things, whether it is user experience, whether it is a better product or it's a better experience? I think we'll have to figure that out. I think this will happen in one segment. If you look at how what Chaitanya says, there is a different segment which is not getting served. I think they'll also start getting served. But there also, I think the pace with which margin will go will be very high. So I think one needs to be ready for an environment where we need to do things at scale, have more people who can buy the stuff that is being produced. And see, at the end of the day, most of us are intermediaries. We are not the principals, actually. We are not manufacturing anything. We are just trying to, I would say, smoothen the system so that they can buy or sell easily. So the broker suffers in all these things unless until the broker finds the right thing to do. So I would think that all businesses, whether the IMC group or others, I think we should be prepared for transparency, the information asymmetry going away, it getting easier to do everything, and innovation, which is about connecting pools which were earlier not connected or solutions which were earlier not connected, will happen. And it will again cause change much faster than what it has caused till now. And therefore, I think it's important that people understand that things will change. Things will change, I think, faster going forward.
Yeah, very well put. Anish, maybe your thoughts?
Yeah. I think the biggest transformation we are going to see in the next 5 years is a lot of non-fintechs and corporates start offering or embedding financial services into their offerings, either to for engagement, adding value, or like generating additional revenues, which benefits the ecosystem. For example, it could be like, Zomato building like maybe a neobank for the restaurants or for reconciliation, or FMCG company offering a credit card to the B2B distributor, basically, right? Or even an e-commerce marketplace offering a cross-border payment as a part of that part. So that is one big change that will actually going to happen. Now, generally what MSMEs and SMEs can look forward is like, because of whatever the pandemic as well as the demonetization, a lot of things got accelerated, the digitalization journey in the last 3-4 years. Maybe people started with the accepting Paytm or PhonePe and BharatPay, and then moved to the Khata apps. And now all of these MSMEs and SMEs are looking forward for apps to help them grow their business or access to better credit. So there, it will be like a lot of, as Ajay mentioned, like we can actually look forward for a lot more of services which can add a lot of value to businesses, whether in terms of growing their businesses or getting better time or improving efficiency, access to better credit. Simple things like treasury, which was not earlier accessible only to a larger corporate, now even like a small kirana owner who has 3 lakh rupees, like how do we manage his treasury, like those kind of services will come up as well. So this is what entrepreneurs can look forward, basically.
Samarth, move to you.
Yeah, sure. So I think Anish talked about embedded finance. I definitely feel that that's something that's going to happen, right? Finance is going to become a little bit more invisible. Obviously, digitalization is accelerating, and that's an ongoing trend. I think one which I won't even say is necessarily something that's going to change or is new, but customer expectations is going to follow the second law of entropy. It's never going to go back. Now that they've now used to access, they're used to convenience, they're used to speed, instant transparency. That's now rebasing customer expectations, and not just in payments, but across the ecosystem, right? So customer expectations will continue to spill over into different verticals. But more specifically from an SMB perspective, a business perspective, I think internationalization is definitely another trend that we're seeing. We're seeing the advent of the multinational SMB, right? You're seeing small 10, 15 member strong businesses have a balance sheet that's revenue in US dollars, costs or suppliers being paid in Australian dollars, salaries being paid in Vietnam dong or Indonesian rupiah, right? So their entire P&L, their balance sheet is becoming multi-currency. And I think that trend only accelerates as you remove the inefficiencies in payments, make it a low cost enabler. And so you see these new use cases, you see these new value additions on top of it. What those use cases look like is what I'm excited to see, right? Like as we modularize, as we open our platforms, as we open our ecosystems, everyone has the ability to pick and choose, combine these together into their own flavor of Lego and run with it. So I think that's what I'm most excited to see.
Thanks, Amal. Chaitanya?
So, my advice to the the members of IMC, particularly those merchants who are operating with consumer-facing products, uh, would be to invest in building a brand if they aren't already. And the reason I say this is twofold. One is around going forward, the barriers to distribution, right? Distributing a brand are going to go away because of platforms like Udan and other even B2C e-commerce platforms and platforms like Shopify, so on and so forth, right? So the amount of upfront investment you will have to do to get your product out there into the market is going to keep going down, lower and lower and lower. What that conversely also means is that unless you have a brand that stands for something, for some values that the customer desires, it's going to be very difficult to stand out from the crowd and hold your own in the marketplace. So brandification, in my head, is something that I would prioritize if I were in their shoes. So that would be my biggest advice.
Okay, great. I picked up some lot of interesting trends to watch out for the future, and I think it was a very fascinating conversation. Never thought that I, as a banker, would be sitting on a panel with four digital entities. Was getting a feeling of being like a challenger, challenged by all of you all at the beginning of the conversation, but as I kind of went through this whole discussion, the only thing that I could see is there is so much more opportunity for us to kind of work together. There's, of course, a need for banks to sort of reinvent and pivot, and some banks have already started doing that to a great degree. But I think there is huge scope for us to kind of partner. Technology will always kind of help us accelerate some of the new business models. So we spoke about more transparency, symmetry of information. The customer experience will be heightened. So all those trends will evolve, but there is a huge ability for us to kind of come together and work. And in the next 10 to 15 years, I think the face of banking and financial services will look very different. And I think one of you mentioned, probably Ajay, you mentioned that there is still a space for everybody, right? Because our ecosystem is so vast and there's so much of untapped opportunity. It's probably a role that each one of us can play to make it more cost effective. Of course, the revenue and monetization aspects are equally important to ensure that we keep building up scale and we keep building up platforms which are robust. But there is still tremendous opportunity for us to kind of bring banking and financial services to the underserved communities that exist in the country right now and to the small businesses. So thank you so much for this discussion. We are at the end of the hour. Do any of you have any final comments over the next 1 or 2 minutes? Maybe we could make that before I hand it back to Mansi. Anyone, if you want to go?
I think thank you for getting us all together.
Thanks, Mridula.
Thank you so much for having us. Learned a lot.
Okay. Thank you so much.
Thank you.
Thanks.
That must be over to you.
Thank you, Mr. Kaushal, Mr. Achutan, Mr. Adappa, Mr. Bansal, and Mridula ma'am. Well, let's move to the last session of the day and the conference as well. And this is on future of technology in banking and financial services. The expert panel comprises Mr. Dinesh Khara, Chairman, SBI, Madam Arundhati Bhattacharya, Chairperson and CEO, Salesforce India, and former Chairperson, SBI, Madam Vibha Padalkar, MD and CEO, HDFC Life, Mr. Prashant Kumar, MD and CEO, Yes Bank. This session will be moderated by Mr. Arijit Basu, Chairman, Banking and Finance Committee, IMC Chamber of Commerce and Industry, and ex-Managing Director, SBI. By now, all of you know that the agenda and profiles of speakers are on the bottom right-hand corner of the screen. And in interest of time, I will not be really reading out in detail. Regarding the question answers, you know that as well. The question, ask the question section is on the bottom left-hand corner of the screen. Do specify the name of the speaker to who your question is addressed to, and do not forget to click on the submit button after you type the question in the ask the question section. Over to you, Mr. Basu.
Thank you very much, Mansi, for the introduction, and very, very warm welcome to everyone, all the panelists who have come. Dinesh Khara of State Bank, as usual, it is expected to happen in State Bank. He will join in after 10 minutes. So special thank you to Mrs. Bhattacharya ma'am, Prashant, and Vibha, and especially to Vibha because I think she is stepping into a panel which would probably have looked like an 18th floor meeting in SBI, unless you would have been there. But this is very, very interesting, the last session of the day. And really, when we conceived this program in IMC and kept technology as the theme for banking and financial services and how it is getting impacted, we really didn't anticipate how much of value we will get out of it. And in fact, this is also on YouTube. And especially interesting were the sessions by the founders and CEOs of fintechs and platforms, which I found very interesting. Of course, we had eminent people like Bill Winters of Standard Chartered and Mr. K.V. Kamath, and a lot of thing has come. But I think this session is what everyone is finally looking forward to. The reason being, when the fintechs discussed, when the platforms discussed, and even otherwise when the Standard Chartered head came forward, how is it that the traditional financial institutions, a traditional life insurance company or a traditional bank, how they are viewing the changes and how these changes are going to happen in the next few years? I think that is what will make this session very interesting. Once again, thank you very much. All of you have taken time out. And I will start with Mrs. Bhattacharya because she is uniquely placed. You know, now running a tech company and earlier having headed many of the initiatives that have changed. What we'll try to do in the first round is to look at the big picture. You know, not only looking at what has happened in our respective organizations, but how really things are likely to be, you know, kind of being predicting the future. Because we know what has happened, what is available, what is being talked about, AI, ML, cloud computing, blockchain, you name it, even laymen have now been bombarded with these terms. But putting everything together, how is the banking and financial services industry, especially the traditional ones, how would they look 3 to 5 years down the line? That would be my broad question to everyone, but with a specific twist to ma'am. I would just ask you to put your hat on both the sides because you have seen how things have developed over the years in the bank, and now you can perceive banks from a different standpoint. So both the things, if you can address and kick off, over to you. Ma'am, you have to unmute.
Yes. So first of all, thank you very much, Arjit. Yes, it does look like a 18th floor board meeting of SBI actually, other than Viva, and she could have been the guest speaker of the day for one of our board meetings. But you know, having said that, thank you very much for having me here. Yes, you know, it is indeed a privilege that I have had so long as a banker, and then having stepped into a cutting edge technology company, one that is native to the cloud, it's born in the cloud with all of its offerings on the cloud, and today actually is looking at, you know, absolutely meteoric growth. So, the growth trajectory of most of our companies itself is giving you some idea as to the way technology is impacting everybody's life. If you have watched the results of our bellwether stocks, whether it be Infosys, whether it be Wipro, all of those have come out with fantastic numbers. They've all upped their guidance. It just shows that at this point of time, everybody is realizing three things. And this is true of the BFSI industry, this is true of other industries as well. The first thing is that you have to own your customer, and you cannot do that unless you have an omni-channel access to your customer. So, the customer access has not only to be digital, it has to be hybrid, it has to be omni-channel. Because you do not know which is the channel that will remain open for your usage, because we really and truly have now entered the VUCA world. It's no longer something that will get discussed in conferences, it is now a reality. That's the first thing, own your customer, and to own your customer, you have to go omni-channel. The second thing that we are seeing is that you have to also allow your people to work from anywhere. That's going to be a trend that's again going to gain ground. And this is there not only because it gives you flexibility in allowing your workforce, but it enables you then to tap those pools of talent which otherwise was very difficult to tap. So you'd have, organizations not getting talent because, that particular geography didn't have that talent. But today, if you make work from anywhere available to, to your entire people, then it doesn't matter whether they are sitting here or whether they are sitting 300 kilometers away or 3,000 kilometers away, they can still deliver, right? So that's going to be the second thing. And the third thing I think that is very important to understand is that we have to all become very agile and very nimble, because situations are going to change on a daily basis. We don't know how situations are changing on a daily basis, but we have got to know them. For instance, let me give a very simple example. You have the COVID map of India, which is put out by the government of India, the Ministry of Health. And it shows you, in certain places it's green, certain places lots of red dots, certain places it is amber. So it's showing you what is the COVID likelihood. Now, if you superimpose on top of that a map containing the places where you have loans, or in case of Viva, where you have policies, you will probably get to know what are the risks that the banks are running in those areas, and you can change your strategy accordingly. So the green areas, they can continue to lend. The red areas, you've got to think of restructuring. The amber areas, you put them on alert that you have got to be more careful. So, and again, as it is a daily change, you can change your strategies accordingly, because this is what is today available. There is so much of data available. So if you look at the BFSI sector, I think, we are really looking at convergence of technology, convergence of data, of artificial intelligence, and basically intelligent automation. That is, you really and truly have to get all of this together. Not only that, you are also going to see a lot of humanization of the robotics that is currently being used. We have a lot of chatbots and things like that that are being used by banks. And many of them actually don't give you that same experience. But over a period of time, what we are finding is that we can make these chatbots more and more intelligent, so that, the experience of the other side becomes far more realistic, far more like a human interaction, and therefore far more engaging. So all of these are the sort of changes that we see going down the line. And if you look at it, I think what really we need to do in the BFSI sector, at least, is to understand that the world is changing very, very fast. And therefore, it's important for us in the BFSI sector to be able to understand where the changes are happening and to become agile enough to adopt those changes at the earliest.
Right, Mrs. Bhattacharya, I think the big picture that you have painted is that we can still survive. I am using the term we because I am also...
Yes, we will survive. By the way, there's no question about that. We will all survive. But it will have to be a collaboration between the old and the new. There's no question about that. Nothing happens without collaboration. And even, if you're looking at the fintechs and, the various other players that are coming in, not only fintechs, there are various other players that are coming in. But there are these meeting points. There are these features, where each can sort of buttress the other. And I think that is something also that absolutely will be happening in the next few years.
Right. So that was I think, the broad theme which came out in our earlier panels as well. And I think you made 2, 3 very important points that we understand that customer centricity. But customer centricity, we now today understand as being good to the customer, serving him well, but not so much customer experience, which you talked about. And also the ability to collaborate. I think these two will be extremely important for the entire financial services industry, specifically for banks. If I may turn now to Viva to give the big picture. And again, when I ask you to give the big picture, it's not just on insurance. Of course, you will be speaking on insurance. And insurance, incidentally, there is a very interesting point which came out yesterday. I think one of the fintech founders and CEOs, he said that they do a lot of insurance sales from their platforms. What he said was that they look more at the general insurance products. So he called it is easier in a digital world to sachetize, to put general insurance or health insurance products in that. So maybe that is one other thing that you could touch upon when you look. But given the size in which you are operating as one of the largest life insurers in the country and the kind of changes that are happening, one is overall your view on this sector, as well as how you see BFSI getting impacted by technology, and where will we be in 3 to 5 years' time?
So thank you so much, Arijit, as well as IMC. Happy to be here. Very senior colleagues on my panel, but I'll make an attempt. Starting off with insurance, and I think it equally applies. And I think what ma'am mentioned about various things completely agree in terms of the customer experience, omni-channel. And I want to start with omni-channel because today you can't really compartmentalize where the customer is going to be. Earlier way of servicing was that the customer comes to you. He could walk into a branch, he could call you, or she could write to you, and so on. Today, we have to be where the customer wants to be, in the mode that he or she wants to be, in the time. A lot of people, especially younger people, have time only late nights or weekends, and that's where we have to be. So absolutely, in terms of it's exactly like various gadgets that we use. We start off viewing something on one gadget and end somewhere else, or start off with a conversation on one and end somewhere else, and it's seamless. That is really how the customer is expecting today in his or her world, whether it's in banking or in insurance or in mutual funds or whatever it is that the individual is transacting. A few points that I want to make is that the digital world is here to stay and thrive. And agility, ma'am mentioned in terms of agility, that is extremely important. And seeing an opportunity in all of these. I'm often asked the question, and I'm sure bankers are asked this question, that is there a threat from the new kids on the block in terms of fintech? I don't see that at all. I see it as a partnership. I see it as they have no interest in having large risk on their balance sheet. They don't have any intention of perhaps dealing with the kind of manufacturing of products or hypothesizing what products might be there, or dealing with customer angst and so on. So there is this sweet spot in terms of the partnership, and that's why I think we engage through our Futurance program of talking to many young startups, and maybe out of 100 we would select 10, and maybe we'll be successful on 1 or 2 in terms of going ahead with the use case, and that's a good place to be in, because we don't know which 2 that are really going to work. But the only way is to talk to a lot of these youngsters, and to be able to figure out how we can take the kernel of the idea and move a lot of routine aspects. That is one. And second is, how do we anticipate using AI ML as to the fact that the customer has bought something today or wants to buy something today, and even before he or she has opened their mouth in terms of the profile, a very good idea as to what are they going to do next. Very good idea as to what is the propensity for a missale, for a complaint, for a fraudulent claim. What this allows us to do is to have a lot sharper pricing, a lot sharper customer servicing of, if you like, the good eggs. Because today we are largely doing this, a lot of what we do is in the blind, and it's in the probability of very large numbers. And this is across BFSI. So the sharper we get, and through use of analytics, the sharper we get, we are able to differentiate and innovate for various customer segmentations. Just stepping back, the way I see this for the insurance sector is in 5 parts. One is simplifying the journey and all that it entails to just reduce how much of data that we ask from the customer, how many hoops we make the customer go through, and that is using a lot of tools, and also some predictive modeling in terms of, like I mentioned, we have a good sense as to who this customer is, and we have tied up with 40 new ecosystem partners, those who are new kids on the block, and these are very large volume transactions. And I want to address your point about, I think you mentioned statutization. Absolutely right, but this can change. And that's where we come in, wherein we know that this can change. And some of the moats that we see today, in a way, that are helping the life insurance sector from disruption, will get disrupted. Um, some of them are even regulatory modes that are helping us, but that can change again. So how does one go towards bite-sized life insurance? And typically, you're going out on a holiday, adventure sports, or some other activity. Often we sit in the flight and think, when I get off, I am really now going to get around to getting more life insurance, and then we forget about it. So we can do it, when we're sitting on the go, on the fly. So those sorts of things I think will happen, and that's when I think the ease of my first point about journey simplification. Second is in terms of the integration with partners, a lot of open source APIs. So we've created an API bank itself, wherein, like some of the very big global players, we just have something like 12, 14 in our bank, and we tell our partners, you can choose whichever API you want to integrate with us, so that the onboarding of that partner becomes, very, very less time, as well as it's like a bouquet of offerings. Third aspect is that service simplification. Again, they're anticipating what the customer wants, and like I said, 360-degree view of the customer, giving pre-approved sum assured, being able to assist the customer, do a lot of self-serve. There is self-serve, and there is really deep understanding of the customer, and knowing the next moves of the customer, upselling in a sensible manner rather than carpet bombing, value added services to the customer in terms of wellness, in terms of estate planning on the pension side, creating platforms and ecosystems so that it's lesser about, I have a product and I'll chase you until you buy, to saying, hey, you are 50 and above, have you started thinking about these things? And what if, do you know that inflation still is going to rear its head in India? And against that, net of inflation, one's savings are going to be close to zero. And at the same time, we are outliving our retirement age by at least 20, if not 25 years. So have you thought about this? And don't pitch to him or her for a very long time until, you've created a pull for that concept of whatever it is that they're thinking about. It could be pension, it could be health, and some of the adjacencies like that. And finally, risk management, important to all of us in the BFSI sector, wherein use of a lot of these analytics would help us in various ways. I talked about fraudulent claim, some other unwanted kind of behavior patterns, especially when organized people get into this, for us to be able to checkmate. So I think it's a combination. How we use these tools is really will be a differentiator. So, like you mentioned earlier, Arijit, that AI, ML, these have become home terms almost. But the use of it in a sensible manner will differentiate the companies that can take advantage of opportunities as they unravel. As against a cookie cutter to say, I engaged somebody and I've done it. It doesn't work like that. It's an ongoing discovery and quite a lot of intimacy with one's customer and future customers. So I'll stop there and hand it over back to you.
Thank you, Vibha. Before I summarize what you said, and it was very interesting, let me at this stage welcome the SBI Chairman, Mr. Dinesh Khara. Welcome, Dinesh, to the program. And just to give him, because he was held up due to an urgent matter, just to update him on what we spoke about in the 10-15 minutes he was not there. I would start with what Vibha said. So in the first round, we are discussing the big picture. And I think, Vibha, you made some excellent points, again, reassuring us that BFSI will survive not just 5 years, 10 years, but essentially using technology which is already available, but which will come, and ensure that 4 or 5 critical areas which will enable our organizations and institutions to flourish are taken care of, whether it is customer service or it is risk management or it is data analytics for some other purpose, and doing it intelligently, that is by collaborating with the fintechs and others who would be coming up. So gives me a lot of comfort, because on a lighter note, one of the other speakers, I hope he was also on a lighter note, he said, I don't see too many buildings coming up in BKC in future. So that was a warning that he gave. Of course, by the end of his session, he said that, no, we will be collaborating. And I think he's one of the biggest collaborators with the banks. But before I come to the SBI chairman, who would obviously have the biggest ringside view, I would like to first turn to Prashant. And Prashant, in fact, has the entire globe behind it, so that gives us a lot of confidence. And why I thought that he would be very appropriate for this session, apart from the fact that he has ensured that everyone continues to call yes, yes, right? So that itself is a big contribution that you have made. But going by, irrespective of the problems that the bank face, I think there is universal acknowledgement about the technological developments and the technological prowess that Yes Bank had developed. In fact, even when I was in the bank and I had met not just Yes Bank people, but people who were connected to the financial ecosystem and who had very high words of praise for what has been done in a very short time. And I think it is one of the critical pillars on which you can sort of rebuild the bank. So again, from that perspective, one is, of course, you would be speaking a little bit about Yes Bank, but given that pedestal, how do you see things 3 to 5 years down the line, which is what we are discussing now, not just for Yes Bank, but for the sector as a whole. Over to you, Prashant.
So thanks, Arijit. And when you were speaking about the big picture, so I was just thinking whether this is a 40,000 feet view or this has become a 53-mile view. And maybe in a week time, it would become a 60-mile view. But I think on the technology side, absolutely, Yes Bank has always been seen as something which has been able to develop the different technologies for the customers. But I think if we largely see on the BFSI sector, I think the most of the focus has been more in terms of enabling the frictionless dispensation of the financial services. This is more on the transaction side, and we are able to lower the cost of transaction, lower the cost of onboarding for the customer and the businesses. But fundamentally, it is more on the transactions. And I think after this advent of ATMs, the UPI, that has been the biggest innovation. And not only for the country, but I think globally, I think this is the biggest innovation. But I think going forward, what we need to work. Now we need to move one step up from the transaction. And I think the immediate areas of interest which we are seeing, one is on the eKYC. I think eKYC is still, which is a very costly affair, which is a very time consuming. If I just recall, like a recent World Bank report was talking about that if we go for eKYC, then the cost would come down per customer from almost $23 to 50 cents. And the KYC, normal KYC, which is taking almost 5 to 7 days, could happen in the minutes. So I think this is something which maybe I have just come on the ground, and we need to work on the eKYC. The second part is in terms of the digital storage of the documents. I think that could be a big help to the customers. and not only helping to the customers, but for the institutions, banking and the insurance institutions alike, the integration of the financial services, that would be very, very important. And especially after the Aadhaar, to have more inclusive, like large number of population is sitting across the country, and the Aadhaar enabled payments can have that inclusiveness. But if you see in terms of future, so after taking care of this part, I think the biggest advantage which I would be seeing on the distributed ledger technology. This is something, and where like there is no need for a individual financial institution to work on their own distributed ledger technologies, but in terms of collaboration. And at least I am seeing two immediate use cases where I think the entire ecosystem can work together. One would be taking this technology into the lending services. Now, lending services, not only in terms of authentication of the documentation, but also in terms of credit prediction and the credit scoring. So this is one area which would be, I think, next stage of revolution in providing the banking services to the common person. And similarly, after the credit underwriting and the credit prediction, also in terms of disbursement of funds. Now, disbursement of funds can happen across the financial institutions. So this technology blockchain could be of very, very useful. And the second use case which I am seeing would be very, very interesting and useful. And this would be in terms of digitizing the entire trade finance lifecycle. And this trade finance life cycle, if we can do the digitization using the blockchain, again could be of big help to the customers as well as to the financial institution. But especially coming to observation made by you in terms of for over a period of time, Yes Bank has been able to build. So I would just like to mention some couple of points, which was the part of the institution. The first thing, it's a huge focus on the institutional digital ethos. So I think what has been done, aligning the workforce with the core vision of the bank's technology strategy, I think that is something which is very important before taking it to the customers. The common language and the interpretation of the digital strategies across the banks, so that can basically avoid the silos, and a 360 degrees the digital strategy. So I think that is something which is very, very important. And also at the same time investing in the core infrastructure and developing the new technologies like APIs. But I think fundamentally we believe that there is no need to build everything alone. I think this is the time where we need to have a alliances and relationship with technology. So this is the time for the ride on the core competence of your partners to create solutions. And also this is the time for the collaboration instead of everybody trying to do its own.
Right, Prashant. So I think the collaboration is very well taken. But one very important point that you mentioned, and I think it resonated very well with me, is that, you know, in your bank, what had happened early and which probably led to its success in technology is to get everyone on board. You know, so you can adopt or have a tie-up with the best technology firms and get the best software. But unless you are able to change the culture around the organization to be able to use that, things don't work out as successfully as possible. And I think going forward, the institutions which do that better will be better placed, you know, in the future 3 to 5 years to come. So now I would come to, of course, SBI, and SBI gives us a huge advantage, you know, and the SBI chairman is the best place to speak about what is going to happen to the entire sector. So Dinesh, the question for you is that it's not just when you are not only heading the largest bank, you are heading the largest financial services system, and each of the subsidiaries of SBI also are virtually, many of them are either the largest, and you can have a 360-degree view. So from that perspective, this round, as I mentioned earlier, we are trying to discuss the big picture. We'll come to some of the details subsequently. That where do you foresee, not just SBI being, but other banks and financial institutions, NBFCs, insurance companies, where would they be, say, 3 to 5 years down the line? Will it all become fintech platforms they would be taking over? Or is it that we will have the wherewithal to not only withstand that, but be able to create something even bigger? So over to you. And thank you once again for taking time and coming in a difficult situation.
Thank you very much, Arijit. It's a very, very thought-provoking and quite engaging subject which you just talked about. And particularly for a organization like State Bank of India, all of us have seen how we have moved, what the journey has been. I think perhaps we cannot forget the days when there used to be electronic typewriter in this bank. And today is a day when we talk about AI, ML, and also we talk about robotics, process automation, and also all these new terms. We also, when we started our journey, we used to have the customer who was a customer of a branch. From there, he became a customer of a bank when we introduced core banking, and today he is a virtual customer. So he can move anywhere. So that is something that's the journey of the customer in the banking and financial service sector. When I say so, it very clearly means that the ecosystem has evolved over the period of time, and that ecosystem is something which has helped in providing more and more services to the customer and to the best of their satisfaction. Well, of course, this is something which is more like an outcome. But when we look at the input metrics, the kind of things which have really happened over the past many years or couple of decades, and more so in the last about 5 to 10 years time, that is something quite remarkable. The way the ecosystem got evolved, the way analytics was being used for enhancing the customer experience, I think that gave enough insight into the customer behavior. So customer became, we used to talk about the customer centricity, but for all purposes, the customer centricity was at play in last about 5 years time. When we tried to understand the customer behavior from each of his transaction, which was perhaps done in a very subconscious manner, but nevertheless an attempt was made. And we have seen within the bank that when we started leveraging that kind of a customer experience for the first time for one of our subsidiary, which became a pilot case, and eventually that led to a huge success within the bank also when we replicated the similar experience for identifying the target customers who can be reached out for offering the pre-approved personal loans. Happy to share, during the period of COVID, when nobody was permitted to step out, about 15,000 crore worth of book was created only through the PAPL. So that is, I think, these are some of the things which we have seen, we have experienced, and going forward, it is going to further go up only. Those early successes have given us enough insights into what all can be done leveraging analytics and what all can be done for acquiring the customer at hardly any cost. So I think typically as it happens, as the economy moves towards the developed status, there are always challenges in terms of the profit margins, and that is some of the commercial consideration which push all the commercial entities to look at the ways to conserve cost. And I think that is something which we have started realizing and we have started practicing also on ground. Having said that, we also look at the technology essentially from the point of view of having an oversight on the operations. As you're aware, with about 22,000 plus branches and about 6,000 plus BCs, etc., oversight is very, very critical. And how to really ensure that kind of an oversight because for banking sector, unless and until we have a very strict and tighter oversight, we run a huge operational risk, which I think an entity of this size, and for that matter, any bank cannot afford. So I think with that in mind, we have started leveraging the analytics, particularly from the point of view of profiling the customers, and if at all there are any exceptions which are there, how to really reach out to the customer and also ascertain from the customer to the satisfaction of the bank whether they have really carried out such transactions or not. We are actually developing various models, and already in our ESS department, which we have hired some data scientists, and now we have come to a stage where we have developed models in-house, and also going forward we are going to ramp up significantly, because analytics is something which I very firmly believe holds the key for any financial sector institution, and more so for a bank of this size. I think blockchain, which was rightly pointed out by Prashant, holds a key for growth and also efficiency in operations. So that is the other very important area. What I feel is that all these new developments which are happening, perhaps when it comes to the IT stack in the bank, we'll have to keep on upgrading on an ongoing basis. If I may say so, we have all the legacy organizations have actually adopted technology in a very incremental way. And in the process, what happens is that we actually, beyond a point, we start experiencing the system related inefficiencies. So I think at a point of time in the organization's life, there comes a stage where they have to start looking at, if at all they have to remain nimble footed, they have to have the efficiency of the system also, and they have to revisit how they can actually cut across the bylanes and make it a highway, system highway. So that is something that becomes a necessity, because unless and until there is an optimization of the computing capacity, there is an optimization in terms of the time taken to market, there is always challenges. So I think an organization of this size always experiences those kind of things. Having said that, the last but not the least, which is perhaps the most important aspect, is the security concerns, particularly for a bank of our size, and which actually serves to the variety, which serves to people across the country, where the literacy may be, the digital literacy may be anybody's guess. So having said that, how to ensure that the customer stays protected, customers' credentials are not compromised, I think there also analytics has started playing a very important role, so that it helps us in raising red flags at the appropriate time, and we can reach out to the customer. So these are some of the immediate things which I can think of, essentially from the perspective of the customer. Whereas when it comes to in-house, the risk management becomes a very, very important aspect, and there also we are leveraging analytics and see that how can we mitigate risk, how can we actually predict the likely risk which is sitting in the portfolio, and how can we decide in terms of enhancing the control measures. So I think that way I would say that the way the banking is today, it is more technology than the banking per se. Going forward with the kind of variety which banks like ours handle, I think it is the role of technology is going to be very, very pervasive all across. Thank you, Rajit, once again for giving an opportunity to be part of this illustrious group.
Thank you, Dinesh. We'll come back to you. Actually, we won't let you go so easily. But I think 2 points that I got from this thing, very, very important, and I think we should touch upon this when we have a technology conference. One is security, and there is no end. So when I was in the bank, that was the thing which used to keep me awake at night. Whether there will be something, and very rightly you touched upon that. The other one is for all organizations, we have to outlive legacy and completely reimagine. I think that's I'm very happy that you are looking at State Bank's transformation in that sense, and I'm sure you will make very good progress, because that's what is required. Initially, we can only make incremental changes, but if technology were to really come and hit us, completely reimagining. And I would reckon that even for 20-year-old company like HDFC Life, that will hold true. While you are a new generation company compared to 1806 SBI, but in 20 years you are already an adult, and you might have to completely relook the journey. So based on what we learned in the first round, and there were very, very valuable points made, in the second round I would like to discuss some of the challenges. So we are more or less decided that banks and FIs will survive. They understand the ecosystem, they know that they cannot do it on their own and they have to collaborate, and they have also identified the areas in which they have to do it. So, Mrs. Bhattacharya, ma'am, once again back to you. I will start with the challenges that I see. One challenge is lack of understanding. So I mentioned that briefly. We all know today there is artificial intelligence, machine learning, there is blockchain, there is cloud, so on and so forth. And people who attend seminars or read up newspapers, they're all familiar. And that is true of people who are running the banks also, banks or life insurance companies. But apart from, I would perceive that itself is a challenge. But what are the other challenges, or that challenge of knowing about a thing, but how exactly to execute? How should people and organizations go about addressing it? Ma'am, you're on mute.
Yeah, sorry. See, if you look at it, and if we look at our customers, for instance, I think the way you have to execute it is first you do assessment of what is the digital maturity of that customer. So if we know that this is the goal, do I need to climb 2 steps to get to the goal, or do I need to climb 20 steps to get to the goal? Once I have an understanding of that, you can then start, doing the transformation layer by layer. Not everything has to be ripped out and replaced. There are very many ways of sitting on the legacy systems and still becoming agile. So middleware is available that will provide or create for you API libraries, which can then consume others' API related applications, or enable others to consume your applications. So, there are ways of doing this. But I think the first and foremost thing that we must understand is that we have to understand what is it we are looking for. If you were talking about security, and there was a lot of talk about security. Now, is on-prem more secure than the cloud service providers? Now, if you are looking at on-prem, and we all know what on-prem systems are, yes, you have very strong physical security, but do you have equally strong logical security? Because logical security is something everybody is trying to hack at all points of time. Now, if you look at the cloud service providers, what are they doing? Their only job is to do that. Whereas if a bank insists on on-prem, they have to subdivide their attention between the customers and this. So the fact of the matter is that is where we have to take calls as to what is it that we will accept of the new technology. We talk about cloud, but when it actually comes to putting stuff on the cloud, there is a lot of fear in the sense that we feel that on-prem is better. But is on-prem really better? And if you look at worldwide, in the last, I think, 1.5 years, almost 35% of organizations have now gone in the cloud, because they realize this is a job that cannot possibly be done as well by them as it can be done by the CSPs, whose very life depends on ensuring the sanctity and the integrity of your data. Okay, that is one piece of it that we have got to realize. The second piece of it is, the world has gone through a kind of Uberization. We all believe that. So, now everything is becoming a service, because nobody has the time to sit and start building. If you are of a mindset which we had earlier in the bank, that we take a platform and we'll build on it exactly as per our specifications and get there, then what happens is that the time to market increases. However, if you go in for very low customization and instead use services, then what happens is that your time to market becomes much faster, your upgrades happen much faster, and you can change your products in a much more agile manner. So, Viva was talking about the API libraries. API libraries are absolutely required. It's the easiest way to to consume, the new forms of technology. And the fact of the matter is today, in fact, I read another word, which is DaaS. Means I had heard of SaaS because ours is a SaaS company, which is software as a service. I had heard of PaaS, which is platform as a service. Today I read of DaaS. DaaS is a desktop as a service. Now, I didn't know about a desktop as a service. So basically what is happening is you sit with your desktop at home. Okay. Desktop is yours. Everything is yours. However, you will be given a virtual private network, a VPN, which is a secure network. And with that, you will be able to connect with whichever organization you're working for. And the queuing of your jobs will happen in an intelligent manner so that your expertise, your hours, your timing is the time when this thing starts hitting your desktop and you accordingly work on it. So basically, I know of one of the very large conglomerates. They are doing away with their call centers altogether. They are allowing their call center people to actually sit at home, and then those people, they book the hours that they want to work in. Okay, they can book it by hours or they can book it by number of transactions. And if you are working at an hour when most people don't want to work, you'll get paid a little more. So if you're doing a midnight shift, you get paid more. If you're doing a regular shift, you may be getting paid less. And depending upon your expertise and the amount of stuff that is already in your queue, the queries or the customer inquiries or the problem solving, whatever it is getting queued to you. They are now really experimenting with this whole setup kind of a thing, and the cost of these call centers have come down hugely because they don't have to have the kind of installations that they had before. Plus, they are able to measure productivity to such a level that the cost of transactions again comes down on the basis of productivity, and you can make more money the more efficient you are. So, the all kinds of, what should I say, everything now is becoming more and more specialized, and everything is becoming more as a service coming to you. So it's all going for a very asset light, capex light model. It is not an asset heavy model. And that is something that I think, the BFSI sector has got to get it. That, you cannot have the capex heavy model anymore, because we are seeing outages in banks. Why is that? Because everything is on-prem, and in order to increase your on-prem capacity takes time. It's not something that's very easily done. However, you go on the cloud, you can be absolutely elastic and you pay as per usage. You're not paying for the whole lot. And again, it's in the hands of experts. So, we need to really think through what is it that we are trying to achieve over here. Banks becoming technology companies is probably not the answer. But banks using technology to the maximum extent possible is probably the answer. Because otherwise, what happens is you are still restricted within yourself, and that ensures that you don't get the kind of global knowledge that is required in order to ensure the maximum security, the maximum agility, the maximum innovation that is coming out in all parts of the globe.
Right. No, I think you made very good points, and this DaaS seems more like a COVID-driven innovation. In the sense that people are now required to actually stay at home, and maybe there are already tech companies working on making how VPNs can be streamlined and made. But yes, I would fully agree that the service, how you make these services available and how you utilize services, both the sides of the coin, that is how you have to reimagine the journey. But Vibha, taking on from what Mrs. Bhattacharya said and what you had also earlier said, that there are some, you outlined very well, 5 or 6 areas that could be looked at so that we continue to thrive in the new scenario where technology is changing. But again, to your mind, what are the challenges? What could come in the way? Do you face any instance of trying to do something and then that not happening as quickly as it should happen or not happening at all? What is your take on that?
There are challenges. Some are, I would say, growing up challenge, which means that, we've just, since March, everyone's really accelerated our digital journey. Some of us maybe a little bit earlier, but largely since COVID struck. So I'm hopeful, I'm an eternal optimist that we have to keep chipping away at this to say we need this to be able to make inroads. And one such area is that, anonymity of fellow Indians is also a limiting factor, and that juxtaposed with data protection. I understand both imperatives, but data is the new oil. So within checks and balances, so rather than saying, we shall just not allow because this is a no-go from a data protection point of view. But what if the customer wants to say, okay, here's my data, or here's my data in a cohort, and you can tap it or through a bureau like an IIB, or a neutral bureau like that. So that becomes an extremely limiting factor for us, whether it's in risk management, whether it is in giving a highway journey to somebody because he or she is maybe the profile is such that we can take on a punt on that individual's life without giving them any trouble whatsoever. Today we struggle with that. We struggle with that in metro salaried. So you can imagine what we struggle with in interior India, wherein the reach is virtually impossible because of even digitization of birth and death records. Today we are able to tap death claims only up to a certain away from a certain metro, a few kilometers away from, and once you go past that, it is not something that we are able to tap. So we are able to do that, and it's something that I can see what we have achieved as a country on the back of Aadhaar and some of the other initiatives. I think even something like Beam or other such facilities that were just not available to us. I'm hopeful, but without that, we will struggle. Without that, it will be just something that we're doing on a periphery, not really deeply figuring out and being able to optimize. So that is one. Second is regulatory, wherein I think the new norm is what we are doing just now is as good as sitting in the same room. So regulations need to understand that and not put barriers in terms of, okay, you can only sell up to 50,000 rupees policy or 1 lakh. Have the checks and balances to record or whatever is required. But let's not put these barriers because this is the new norm. People are, even in interiors, comfortable with a WhatsApp call. So the fear of unknown, and ma'am mentioned about cloud. That is a big fear of unknown. We have moved to cloud, for example. Yes, with checks and balances. Yes, with baby steps to start with, and increasingly various parts of our portfolio. But it's not doing it is somewhat of a Luddite mentality, I think. So that is the second part. Third is medical data opaqueness, and some of that goes back to my data. The way credit offtake has happened on the back of a lot of credit bureaus and information that one can ping. We need medical information for insurers because that is a very critical piece of data, perhaps even more critical than KYC. And today we have none. We can go to any small nursing home and get whatever, and insurers will not be able to know it. So again, within data protection norms, that is that needs to be resolved. As far as work from home is concerned, shifting away from customer to employees, I do see it as an opportunity and a threat. Opportunity for the obvious reasons of getting to talent, like ma'am said, that otherwise would not be available, especially women. So that enthuses me. But at the same time, I do worry about culture. I do worry about the camaraderie, the serendipity of it. Just ideas out of brainstorming with unscheduled video calls, for example. How does one create that with new talent that comes in? That is an aspect that I think needs to be resolved. So the technology is there, people are getting used to it, but also the phygital way, is that a more realistic way? And finally, I think in terms of the promise and the delivery of the promise. So digital is not the panacea, or the final nirvana, because if your underlying processes are broken, just it's like putting lipstick on a pig. It's not going to change the nature of the underlying product offering or the service or whatever it is. So I think we should not be too distracted by the tech piece of it. It's useful, but useful, like I said earlier, also in a manner that one is channelizing in a sensible and intelligent manner, and not letting tech drive core decision making.
Right. Thanks, Vibha. As usual, excellent points that you made, and especially one that will resonate with many other, at least insurance participants who may be logged in on regulation. So, we do have a regulatory sandbox set up by IRDA, but I don't think that's enough. The ability to be receptive to new ideas, and in general insurance also, so many things are happening across the globe, and we have not been able to take it up. And internal
Sorry,
challenges.
sorry,
Please go
Arijit, I
ahead.
just want to make one point. So, for example, we are very enthused by build your own insurance policy. So, for example, if I'm XYZ profile and I'm never going to use certain features of it, in my mind, I think that, I'm paying for something that I'm not going to use. So, build your own policy, which is on digital, wherein, you can visualize, you drag and drop like you do in a Amazon or a Flipkart basket, and build your own, whatever you want, or a big basket or whatever it is, virtually. So ideas like that, how do we enable with all the checks and balances that are necessary, but should not limit innovation?
Right. No, excellent points. And the other one which I liked is about the process being in tandem with the digital prowess that the organization is building. If you are not able to change that very quickly, that is one challenge that we are going to face. And taking off from that, and turning once again to Prashant. I think Mrs. Bhattacharya briefly touched upon it, but I wanted you to dwell a little more, because as we come into a tech conference, there are many participants who are actually thinking of these questions about how do we ensure safety and security both for the customer as well as for the organization itself. That there's huge amount of risk, when we are dealing in finance. And we have recent examples of very reputed banks and financial institutions being found wanting. And you must be thinking of it day and night. So what are the things that you are already doing, and what more should be done? Can we use AI? I once read that, AI can be used even for ensuring whether cybersecurity is on guard. Any ideas that come to your mind which you would like to share?
So, Arijit, I think one of the challenge which the entire financial sector is maybe facing, or maybe which is going to come in future, that for all the financial entities, irrespective of the physical age, I think from the technology perspective, everybody is either 15 to 20 years old. And the way the systems have been built up, so initially there was a core system, and as per the requirement of the customer and the ecosystem, continuously we were doing some patchwork. So it was not a very, very systemic development in terms of how we would like to develop our systems. It was more in terms of responding to the needs of the customer over a period of time. Unfortunately, we have reached to a situation that though there is an expectation from us to be agile and also nimble-footed, but issue remains that even financial institutions want to do that, it becomes very, very difficult. At the same time, when we talk of, say, cooperation with the other partners, I think one of the critical issues which is being faced today in terms of how the third-party service providers are in a position to meet the requirement of the regulators in terms of safety. So I think in what regulatory actions we have seen in the recent past is a pointer towards that direction. And there are large number of, say, service providers who are sometimes beg. They were simply saying we can't meet those kind of standards. This is what we need. You, if you want to take it, please take it. Otherwise, you can just leave it. And this is how some of the other, say, your competitors are already doing it without bothering about those issues. But now we have reached to a situation, and I think almost 4 5 months back, there has been a guidance issued from regulator in terms of how the entire technology infrastructure of the institutions have to be built up and how the financial entities have to take responsibility even for meeting the guidelines from the third party agency. Now this is a very onerous responsibility. And I think going forward, it is not only about the meeting the security standards and the security requirement within the bank or the insurance companies, but also in terms of ensuring that third parties also meet those guidelines. So I think these things are going to be very challenging. And the most important part would be in terms of understanding the entire framework. It is not going to happen overnight, but definitely laying down a clear-cut roadmap how we need to move in that direction. I think that would be very important.
Right. Yeah, I think broadly that is the way everyone has to be conscious day in and day out and look at this. So, once again, turning back to SBI. So, one very good thing that I can share with you, Dinesh, is that you should feel very proud that what you are doing is now being recognized by everyone, not just because of the size. In this conference itself, in about at least 3 or 4 sessions, people talked about SBI as a positive example of what has been done. Maybe sometime in the past, we would not have the opportunity to do that. And there was a lot of recognition for what has been done in technology, not just because of our size and because we are a large bank, but because of the innovation that we have done. So if I may just move away from challenges a little bit, it has got covered, and maybe play devil's advocate and ask you. So there is a lot of respect for what YONO has brought to the table, what SBI has done in innovation for the financially deprived. There was someone who mentioned that. So what is the next big thing that is coming from SBI? Is there something coming on the technology front? Something like I'll just quickly make things easier. There was a fintech person who finally acknowledged that there is no point in us becoming a bank. Then it'll be more of the same. Ultimately we have to also differentiate. If we become a bank, then there are so many banks. So, but for SBI, you can conceive anything. You conceive something like, say, a digital bank, or is there any big thing? And IMC will be delighted if you share it here for the first time. That was over to you. No, I just wanted a big picture kind of thought from you. You are on mute, I think. Yeah.
Thanks, Ajit. I would start by saying that we normally talk about fintech. Fintech are actually not fintech. They are tech fins because they are the technology company distributing financial product. For all purposes, we in the commercial side, we in the banking and financial sector, we are fintech. We are manufacturing financial products and we are distributing with the help of technology. So that's how I look at it. And having said that, well, of course, we started the journey about 4 years back. As I mentioned that over the period of time, technology is changing very fast. So now something which is on the top of our mind is how to minimize the time to market. And having said that, what Mrs. Bhattacharya also mentioned, that is something which we are fully aligned to. I think nowadays, when it comes to IT, there is no capex. It is all opex. Because even if we say capex, it is relevant only for 3 to 4 years and not more than that. So technology is changing very fast, and incrementally in YONO also, when we started YONO, we thought of YONO only as a distribution platform for the retail segment products. But during the course of the journey, we could realize its potential for international operations also, particularly where we had the retail operations. We could visualize its relevance for YONO business also, and how the last, of course, was we started leveraging, for our agricultural segment also. So I think now what we are thinking of is how to integrate all these fragmented pieces of and think in terms of something like 2, which is the next version of that is something which we are working on, and hopefully we'll come out with that with the broader contours of that also soon.
Yeah. So everyone would be looking forward to that. It has been a fascinating discussion, but I have the privilege of, in fact, planned it that way that this would be the last session. So I can see Mr. Ajit Mungrolkar, our Director General, who will be giving closing remarks. But we therefore have the luxury of having one last word from everyone on the overall subject and any thought that you might want to share on this subject where we are saying that how technology is reshaping the entire sector. So I think we will start once again in the same order that we had done this program. So Mrs. Bhattacharya, first shot to you.
So, I just would like to say that, technology is like the backbone of any organization today. You don't have a spine, you can't stand straight, right? So unless you have a very strong spine, very strong technology backbone, it will be difficult to survive. The age today is an age of very quick cycles. The cycles are becoming shorter and shorter, and you can see that happening. And as the cycles become shorter, it's very important to have the right kind of technology, because that's the only thing that's going to empower you to change along with the times, to keep in step with the times. And especially for India, for a country like India, which has a huge population, more than 600,000 villages, you cannot have everything in brick and mortar. The cost of delivery will be way too much. So the only way that we can really deliver all of these BFSI services in the right manner to the right people in an inclusive manner is to go the technology way. And if we think that people are not technology savvy, let me tell you, the current generation, they come technology wired. They are far more savvy than we are, and they are far more amenable to being on the screen rather than face to face, to be able to handle technology well. They are absolutely wired for it. So I think we have to be less timid about this and far more courageous in taking the right steps so as to bring up a society that is inclusive, that is agile, that is open to change, and that is able to deliver the customer expectations.
Very well put. Vibha, next to you.
I would just add to that three things. One is that it is all pervasive for all stakeholders. So it's not just one big mainframe and it's locked away and you think about it when you need to process large parts of data. I think that's clearly history. It's all stakeholders, and the latest AGMs that are happening so seamlessly, the way we have transitioned, it's also the shareholders. Apart from the customers and regulators and transactions and employees, it's also shareholders. It is core to how we look at business models, and it's not peripheral. If it is peripheral and force fit, it's never going to work as well it's supposed to work. So it can't be gratuitous, it needs to be core. And gone are the days in terms of large clunky systems that are not agile. Any technology that does not allow you to react to changing situations is again should be history. Or we should really think about why are we doing this. So the agility starts becoming core because the pace of change is going to be very, very rapid, and it's both an opportunity and a threat.
Absolutely. Prashant?
So I think like technology, absolutely, there are no two words in the sense. It is so important. But I think we need to remember that ultimately the customer is at the core. And whether customer or employee, ultimately we are dealing with the human beings. So I think that technology is important, but I think the human being, they always issues about the emotions, issues about the complexity of the behavior. So I think that is something which we should not overlook at.
Absolutely. In fact, you have addressed one of the participant questions. So this exactly was the question that was raised. I wouldn't know that. So very, very important point that you have made finally. And over to you, Dinesh, for your final comment on this subject.
Well, of course, agility is absolutely essential, but at the same time, convenience of the customer is the most important. Convenience of not only the customer, but also the users, all stakeholders. How conveniently they can use technology will probably make their technology more and more adaptable to all. I think COVID has taught all of us quite a lot. It has been a paradigm change which we have seen during the COVID. The shift in behavior across the universe is something which is visible. But having said that, security cannot be lost sight of. It has to be at the center of whatever is being done. Thank you.
Thank you very much. It has been a fascinating discussion as we thought it would be. And I have personally really thoroughly enjoyed some wonderful points have been made. And I'm sure the participants have also liked it. I once again thank each and all the speakers in this panel, especially for having taken time out. I know how difficult it is to do that. And IMC also would be very, very thankful for your efforts. Stay well. Thank you very much. Over to you, Mans.
I thank the entire panel along with our moderator. And now the vote of thanks will be proposed by Mr. Ajit Mangolkar, Director General, IMC Chamber of Commerce and Industry. Sir.
Thank you, Mansi. And good evening, ladies and gentlemen. Wow, what a power-packed panel we've had. I would like to thank the panelists, Mr. Dinesh Khara, Chairman SBI, Ms. Arundhati Bhattacharya, Chairperson and CEO, Salesforce India and former Chairperson SBI, Ms. Vibha Padalkar, MD and CEO HDFC Life, Mr. Prashant Kumar, MD and CEO Yes Bank, and of course our moderator, Mr. Arijit Basu, Chairman, Banking and Finance Committee of IMC and ex-Managing Director SBI. Thank you for a fantastic final session. I mean, this was a real wow factor for us. Okay, now it's been a fantastic and interesting 2 days of conversations by very eminent experts from the banking and finance sector. It is my pleasure to present this vote of thanks to one and all. A sincere thanks to guests of honor, Ms. Usha Thorat and Mr. N.S. Vishwanathan, former Deputy Governors of RBI, and to all the speakers and moderators to have accepted our invitation and giving their time to share their insights. We are grateful and honored. The Banking and Finance Committee of IMC have put together sessions at the conference which were very relevant to the time we live in, and the speakers in each session are domain leaders leading the technological advancement in the sector. The sessions in this conference not only discussed the future of technology and sustainability in banking and financial services and how fintech and payment banks are redefining the financial system, but also its governance, green tech, opportunities and risks in the fast evolving technological transformation. In a way, the conference as a whole was a complete package covering all important aspects in banking and finance. As new technologies have been transforming and revolutionizing all other sectors of industries, businesses, as well as the way we all live and operate, the banking and financial sectors could not have remained untouched or indifferent to the consumer's expectations. There is more to come. The emerging technologies such as artificial intelligence, the Internet of Things, 5G, and quantum computing are beginning to collectively reshape financial services, bringing new opportunities to firms and consumers alike. These technologies will allow for the development of new financial products and services which would impact individuals and businesses in important ways. While we may not be able to completely predict what is next in financial services, we can be certain that the customer will remain center stage for years to come. IMC's 2-day banking and finance conference was designed to get insights into how technology is reshaping banking and finance and how banks could contribute to India's accelerated growth. We would like to put on record our gratitude to Mr. Arijit Basu, Chairman of IMC's Banking and Finance Committee and ex-Managing Director, State Bank of India, as well as to all the members of the IMC Banking and Finance Committee for conceptualizing and structuring such an interesting conference and bringing together prominent personalities to speak at the conference. We wish to express our profound thanks to our platinum sponsor, HDFC Life, and our gold sponsors, BNP Venture Capital Limited and Standard Chartered Bank. Without their gracious support, it would not have been possible to hold this event. Our sincere thanks to media representatives for their participation and to all delegates for joining in such large numbers on both days. Thank you very much to our anchor Mansi for very efficiently conducting the two-day program. And last but not the least, a big thank you to Team IMC, led by Deputy Director General Sanjay Mehta, Officer in Charge Bharti Salunke, Selby and the IT team, Jayashri and the PR team, and our platform partner Reach Media. It is all their teamwork, ladies and gentlemen, and hard work behind the scenes that made such flawless execution possible. Once again, thanks to all of you, and see you next year at our 12th conference. Stay safe and take care. Thank you.
Many thanks for those closing remarks. And on that note, we come to the close of this two-day conference with the hope of meeting in person for the next event. This is Manasi taking your leave. Stay safe, stay healthy, stay well.